Danny, I think you're on mute.
Yeah, sorry about that. Yeah, so yeah, having a bit of everyone having a technical thing. There was half the people were locked out and Zoom wasn't letting them in, so I had to end it to allow them to change the settings. It wouldn't let me update it while the meeting was going on.
Okay, is everyone in?
Yeah, well, we only about
coming in.
half the people, but
Okay.
I think we can maybe start, because we know it's going to start getting late. I do have the recording going, so hopefully people can catch up.
Danny, I think just give it 1 minute, because it's either are coming in and people have been phoning. So
yeah. So you were phoning me. I had like 5 phone calls going on.
no, my phone is burning.
Yeah. So is my computer. It's like overheating. I turned my fan down. I'm going to have to turn it back up. Let's give it so let's give it another 2 minutes. I'll be back in a second.
Okay.
Yeah, technology at its best.
Yeah, sure.
Right.
But the numbers are coming up, so obviously that is working.
Yeah,
We'll blame Eskom, that's all.
Yeah, that's one of those scary things. Okay, I have tons of emails, so I'm going to focus on the emails. I'll be back to everyone now.
Okay, we'll be starting in 1 minute's time. We'll do an introduction, which should take about 20 minutes, and then
coffee.
So if you really want to make coffee, now would be the time. And we'll be starting. So sorry about the glitches. Yeah, in fact, we'll start at exactly 10 past. It's now 09. We'll start at 14:10. Okay, so welcome everybody to the 2022 year-end tax update with Prof. Jackie Arendse, and as usual, an event which we look forward to. I don't know whether we look forward to this event or the end of the year, but as a matter of choice, but I always enjoy these sessions. I've learned a lot over the years. And Jackie, all I can say is please bring us up to date. The floor is yours.
Okay, great. Well, thanks very much. And good afternoon, everyone. I hope you can hear me okay and that everything's coming through okay. Hope that your Wi-Fi continues to work, that you don't not upset by load shedding, and then we're all good to go. Okay, so sorry, thanks very much.
One thing, just if you would just tell us if there's going to be a break in between and what people can look forward to, if you don't mind. Sorry to interrupt, but carry on.
Sure. Okay, well, let's deal with the admin side of things. So we are going to run through, I had thought until 3:30, maybe we'll make it 3:35, just since we're starting a little bit later. So we'll go for about an hour and a half, and then we'll take a 15-minute break, and then we will carry on for another hour and a bit, an hour and a quarter or so, and that'll take us through very close to 5 o'clock. We'll certainly be finished at 5 o'clock. Some of you might be logging into the SARS, maybe doing a double feature here. And as soon as I'm finished, you might be logging into the SARS webinar on tax dispute resolution, which could be quite useful. So, and I think that starts at 5 o'clock. So yeah, we'll end certainly just before 5 o'clock. Right, so of course, year-end update, we are always looking at the latest legislative amendments. And this year we are focusing on these three particular amendment bills. And that's the rates and monetary amounts. And I see I've made the name even longer than it should be. It shouldn't have the second word amendment there. It should be rates and monetary amounts and amendment of revenue laws bill 2022. And that's the bill that contains all of the tax tables, tax rates, exemptions, and so on. Then we've got the taxation laws amendment bill of 2022 and the tax administration laws amendment bill. Okay, so it's those three that we're going to be covering. Those are the three bills that were tabled when the Minister of Finance presented his medium-term budget speech on the 26th of October. And those bills essentially contain the tax amendments that were identified in the 2022 budget speech. Now, there was another bill, a draft bill, and that was the draft revenue laws amendment bill. And that contained the two-pot retirement system, the new system that is being introduced that will have a savings element as well as a retirement element. But that bill is still now under development. It did go for comment. There was a lot of comment, a lot of discussion, and the whole implementation date has now been pushed out to the 1st of March 2024. And so that bill still has more work to be done to it over the course of the next year. And so we're not going to be talking about that today, but we will cover the amendments that are in these three bills, which, as I say, have now been finalized. And then we'll talk about some recent tax judgments, and I've updated this with some very recent judgments that have come through from the SCA, including the Thistle Trust. I'm sure many of you are waiting to see if we're going to talk about the Thistle Trust today, which indeed we will. And then after that, we'll talk about some SARS documents, updated documents, new documents, and the announcement about the planned withdrawal of Practice Note 31 and Practice Note 37. All right, so there's a lot to talk about, and I'll have to go through this fairly quickly because we are a little bit less on time than we would have been, but we'll go through quite quickly. And as I say, we'll take a break at 3:35, and then we will carry on. We'll take a 15-minute break, then we'll carry on until 5 to 5, and then we will be finished. Okay, so looking at these three bills. Now, of course, as I say, the rates and monetary amounts bill has all of the tax rate changes. I'm not going to, of course, go through all of the new tax tables and so on, but what we are going to just look at is the reduction in the company tax rate, because that now has been, well, it's legislated in terms of it being in the bill that has been tabled at Parliament. Of course, this bill still has to be promulgated, which will probably happen only in January next year. But we know that this happens every year, that we have amendments in tax rates, etc., that go through this whole process, that they're only actually promulgated the following year. And so it doesn't mean that there's anything uncertain here. We can be certain that the company tax rate is going to reduce to 27% for years of assessment ending on or after 31 March 2023. And as announced in the budget speech, even of 2021, and then reiterated in 2022, the reduction in the company tax rate is offset by certain, what they call tax-based broadening measures. So these are measures that are designed to generate additional tax revenue for the fiscus, which is designed to offset the reduction in tax revenue that comes about as a result of the drop in the tax rate. Now, these two tax-based broadening measures, the limit on the interest deduction in section 23M, that they are making that interest deduction, they're making the limit a bit more conservative, and limiting the set-off of assessed losses, the amendment to section 20. These amendments also take effect for years of assessment ending on or after 31 March 2023, although these particular amendments you won't find in the 2022 amendment bill or act, because those were already legislated last year. Okay, so although the actual provisions were legislated, the effective date was left open, still to be announced. Now we know that the effective date is for years of assessment ending on or after 31 March 2023. Okay, so if we have a look at the reduced company tax rate going down from 28 to 27% for years of assessment ending on or after March 23, if we then say, right, we've got a 1% reduction in the headline company tax rate, we need to also compare the effective tax rate on fully distributed profits. So by the time you've taken dividends tax into account. So if you had 100 Rand of pre-tax profits and you paid 28 Rand by way of tax, you'd have 72 Rand available to distribute as a dividend. If that carried the full rate of dividends tax of 20%, that would be 14 Rand 40. And so by the time you've paid the 28 and the 14.40, it means in total you've paid 42.4 on that 100 Rand, or 42.4% as our effective corporate tax rate on fully distributed profits, which have been fully hit with the 20% dividends tax. Under the new rate, of course, it's a 27%. It's 73 left taxed at 20% on the dividend, giving you 14.6. And so our effective company tax rate then goes down to 41.6. So there's your 0.8% drop in the effective tax rate on fully distributed profits, the 1% offset by the 20% dividends tax. Okay, so just an important comparison that one needs to have at your fingertips there. And then, of course, I must also just point out that with the reduction in the corporate tax rate, we see that with small business corporations, the tax table that was published when we had the budget speech in February 2022, of course, this new tax table that took effect for years of assessment ending on or after 1 April 2022, the first 91,250 carries tax at 0%, and then you have the tax rates at 7, 21, 28%. That tax-free threshold, of course, is always in line with the tax-free threshold for individuals under the age of 65. Now, once the new tax rate comes into effect for years of assessment ending on or after 31 March 23, all that happens, so everything on that table stays the same, except that that 28% drops down to 27%. Okay, so just bear that in mind with your small business corporations. And then next year, February 23, we'll have the next budget speech and they'll announce the next table, which if we follow recent trends, nothing changes other than this tax-free threshold, and the tax rates then stay as we have them over here. All right, so that's just as far as your small business corporations are concerned, just to bear in mind that that impact also affects those corporations with years of assessment ending on or after 31 March 23, but it's only the 28% that drops down to 27. The other tax rates all stay the same. Then I just want to talk briefly about Section 23M and Section 20. So although these were amendments that came through last year, but the effective date we now know is effective also for years of assessment ending on or after 31 March 2023. And we've said that these are tax-based broadening measures, that we have got a more conservative limit on the interest deduction provision of Section 23M, and we've got the limitation on the set-off of assessed losses in Section 20. So what exactly is Section 23M? And I just want to clarify that Section 23M actually has a very narrow application, and in all likelihood, there's probably very few of you that would actually be affected by this provision. Section 23M is an interest limitation provision. We actually have two similar provisions, 23M and 23N. 23N has more specific focus. It talks specifically about sort of company restructuring and company acquisition transactions. 23M has slightly broader application, but you'll still see that it is very specific in its application. So it only applies when you've got a debt between a debtor and a creditor who are in a controlling relationship. And that requires that the one must hold basically at least 50% of the shares in the other. So they don't both have to be companies, but at least one must be a company, because the one must hold at least 50% of the shares or have the voting interest in the other. So there's the controlling relationship aspect, which is important. Not only that, but then the interest that flows from the debtor to the creditor, it's income in the hands of the creditor. And in order for Section 23M to apply, not only must there be a controlling relationship, but the interest is not subject to any SA tax in the hands of the creditor. Or to be precise, in terms of the amendments that came through in 2021, there can be a situation where the creditor might be a non-resident company, and is paying withholding tax on interest, not income tax on the interest, but they're paying withholding tax on the interest, but they're not paying the full 15%, and yet they are not paying nothing. They're paying maybe 5% or 10% withholding tax. So they're paying some, but not the full tax rate on the withholding tax. So there would be an element of that interest that would be subject to 23M. There's a bit of a calculation that you do to work out how much of that interest is actually going to be affected by Section 23M. If the creditor is paying full SA tax on that interest, either income tax or the full withholding tax on interest at 15%, then 23M will not apply to that debt. If the interest is not subject to SA tax, income tax, and withholding tax on interest, then Section 23M will apply if there's a controlling relationship. All right, so we first have to establish, when Section 23M actually applies. And as I say, you can see from those criteria that it has very specific application. The scope is very specific. And that's why when you factor that in, you'd probably find not too many of sort of regular debt situations would be affected by 23M. But if Section 23M does apply, then what happens is that the interest on the debt that the debtor wants to claim as a tax deduction under Section 24J, that deduction is then limited to the amount that is calculated according to 23M3. And in order to get that limitation, 23M3 tells us that your deduction is limited to the sum of, so we have to do this whole calculation. We take interest received minus interest on other debt that's not limited by Section 23M, all right, because of course there's only certain debt that would be affected debt that would come within Section 23M. Other interest not affected by 23M obviously is not going to affect our limitation. So we take interest received minus the other interest, and then here comes our kind of threshold. And that is now 30% of what we call adjusted taxable income of the debtor. It's the debtor who's claiming the deduction, right? So the debtor is working out this limitation. Now, adjusted taxable income is a fictional amount that is calculated, and it's the idea here is to get the tax equivalent of EBITDA, earnings before interest, tax, depreciation, and amortization. So we start with taxable income, and we add back things like allowances that have been deducted. We add back the interest that has been deducted. We add, and then we also take off any recoupments, and we take out interest received, and we arrive at taxable income. Then we multiply that now by 30%. Whereas prior to this amendment coming into effect, the limit was set at 40%, and there was a bit of a formula that was done there, and looking at the repo rate, if it went above 10% and so on. But now we don't do that anymore. We simply say adjusted taxable income times 30%. So obviously 30% less than 40%, and so that potentially brings that threshold down. It makes that limitation lower, and that's your tax-based broadening measure. It means less interest can be deducted, and that means that there's more exposure of taxable income that is going to attract tax, all right, albeit at 27% instead of 28%. Notice here that this doesn't apply to interest that's disallowed under 23N. That's the one that deals with the company restructuring or company acquisition transactions. So if the more specific application applies, we use that. Otherwise, we use the more general one of 23M. But even so, it's got fairly limited scope. Now, any disallowed interest is carried forward. So I think maybe just to show you a quick example, very simple example, maybe oversimplified in some respects, but I just want to get across the principle of how Section 23M works. If we had a company, M, which holds 100% of the shares in P, and let's say P is a resident company and P is the debtor, M is the creditor, and M is a non-resident. So P borrows 5 billion euros from M and pays interest at 8% per annum, and that debt is used to fund the acquisition of assets in P's business. All right. So in other words, P is looking at Section 24J deduction of that interest. Now, obviously, you have to translate the interest to rands, and I'm just using a nice round amount of 20. It's a little bit bearish, perhaps, but 20, so 400,000 equals 8 million rand, we're just saying here. And so we're looking at deducting interest of 8 million rand under section 24J for the debtor, right? And once we've made that deduction, we end up with taxable income of 1 million rand. And that's after taking into account everything. We've also taken off the assessed losses carried forward from last year that we're allowed to set off and so on. Now we want to work out what is the actual limit in terms of what we can deduct. All right, so we start with the finally determined or semi-finally determined taxable income of 1 million rand. And then we have to get from there to this fictional amount called adjusted taxable income. So their adjusted taxable income, as I say, think EBITDA, so earnings before interest, tax, depreciation, amortization. So we take taxable income, we strip out the interest income. I'm just assuming these numbers. We strip out any recoupments that might have been added on to get to that number. We add back the interest that we deducted of 8 million. And we add back whatever capital allowances we had deducted, and we add back whatever assessed loss we had deducted in arriving at that number. And so we end up with this number called adjusted taxable income. Right, now, adjusted taxable income, we now multiply that by 30%, but that's not the end of the calculation. We also then add on interest income, and we take off any other interest incurred, interest that's not subject to section 23M. Okay, so that tells us that our interest deduction is then capped at this amount of 3,966,500. We had interest, remember, of 8 million on this affected debt. So we can only deduct 3,966,500. And so we then have to recalculate our taxable income. We had arrived at taxable income of 1 million after deducting 8 million. Now we have to add back the 8 million and then deduct only what we're allowed to deduct under 23M. So there's the limitation. We can't deduct 8, we can only deduct 3.9 million. And the excess, the remainder of sort of just over 4 million rand, we would have to then carry forward, and we can look at deducting that in the following year, subject to the same restrictions. But you see what's happening here, that instead of having taxable income of 1 million rand, because of the interest limitation, we've actually now got taxable income of 5 million rand. Now, in terms of the previous version of section 23M, just looking at the rate amount, it would have been 40%, now it's 30%. So it would have been 40% on, let's call it 13 million, which would have been about 4.2 million. And now it's dropped down because now we're doing it at 30%. So the threshold is lower. So we get less of an interest deduction for this year, and it means more carried forward for next year. And then once again, we'd have to work out the threshold. All right, so that's basically how your section 23M applies. But as I say, you can see because it only applies to debtor and creditor in a controlling relationship, and the creditor is not subject to SA tax on the interest income, that's why 23M has pretty limited application when you talk about just your general business community. All right, let's have a look at the section 20 amendment, which now also takes effect for years of assessment ending on or after 31 March 2023. And this amendment is restricting the use of an assessed loss brought forward from the previous year. And that restriction has been set at the higher of 1 million rand or 80% of taxable income. So you got this de minimis amount of 1 million rand, which was introduced specifically to give concession to companies with smaller amounts of assessed losses, smaller companies, in other words. So this amendment comes into operation, as I say, also for years of assessment ending on or after 31 March 23. And the idea here is that by limiting the set-off of the assessed loss, National Treasury says what they're expecting to see, and this is your tax-based broadening measure, is that you've got some element of taxable income that is now exposed and subject to tax. I've got a question from Mervyn on 23M. Does the interest adjustment not apply if the creditor pays tax? Yeah, no, because as I explained, when it does, section 23M only applies if the creditor does not pay SA tax on the interest income. All right, so back to section 20. When you look at the amendment to section 20, subsection 1, they've now split that into 2 subparagraphs. A, talking about a company, and B, talking about anyone other than a company. And paragraph B, anyone other than a company, the wording there is as it was before, which pretty much allows the set off of that assessed loss, right? I mean, we do obviously have some restrictions that currently apply. For example, if you have an assessed loss on a foreign trade, you can't set that off against a local trade. And there's certain other restrictions like Section 20 Cap A that applies to individuals at the maximum marginal tax rate. And there's also the proviso that exists around a person whose estate has been sequestrated, etc. But those are provisions that currently apply to anyone who's not a company. And so what they're now putting in is this extra bit. Any person who is a company may set off any balance of assessed loss carried forward from a previous year to the extent that the amount of the set-off may not exceed the higher of 1 million rand or 80% of current year's taxable income before taking into account this proviso. Now, just to see an example to show you how this will work. If, for example, we had a company A, which had an assessed loss at the end of June 2022 of 2.5 million, and for the year ended 30 June 2023, there's taxable income of 2 million rand. Now, in terms of the previous rules, all things being equal, you would be able to take current year's taxable income, offset your assessed loss brought forward of 2.5 million, and you'd have a balance of assessed loss of 500,000 that you would then carry forward to 2024. But you can no longer just set off that whole amount of the assessed loss brought forward. You now have to impose this limitation. The limitation is set at the higher of 1 million rand or 80% of current year's taxable income before setting off the assessed loss. And so 2 million times 80% gives us 1.6 million. So we can utilize 1.6 million of the assessed loss, and we obviously reduce our taxable income by that amount, leaving us with taxable income for the current year of 400,000, then taxed at 27%. And of course, we had an assessed loss brought forward of 2.5 million. We are utilizing 1.6 million, leaving us with 900,000 balance of assessed loss that will then carry forward to the 2024 year of assessment. And now if we went to 2024, that limitation again, the limitation for the set-off, it will be the higher of 1 million rand or 80% of taxable income. So regardless of what the level of taxable income is in 2024, because this amount is less than 1 million, you would be able to set off the whole of this balance of 900,000. Okay, just a point to bear in mind, this excess that remains now, this is what is giving rise to the additional taxable income, because obviously under the old rules, you would have had no taxable income. You would have had a balance of assessed loss of 500,000. Now you've got taxable income for 2023 of 400,000, which is going to then trigger tax at 27%, giving you 108,000 tax liability, notwithstanding that you have a balance of assessed loss of 900,000 that you can carry forward to the following year. Okay, so this is creating a very real tax liability. It's having an impact on your cash flow. And bear in mind also that this must be something that you think about when you do your provisional tax returns as well. Don't just wait until your final assessment, but you need to be thinking about your provisional tax returns. The first provisional, of course, when you look at your estimated taxable income, you can still use the basic amount, which in this case, you'd look back and say, my last assessed taxable income was actually an assessed loss of 2.5 million. And so you could use that basic amount for the first estimate. The second estimate, of course, it depends what your final assessed taxable income is going to be. And there you need to be thinking about what is the amount of the set-off of the assessed loss that you'll be able to do. Now here, taking into account the set-off as I've shown it on the slide, you're going to end up with final assessed taxable income of 400,000, less than 1 million. So your second estimate of taxable income can't be less than the lower of basic amount or 90% of final assessed taxable income of 360,000. So there you could still use your basic amount for your second estimate. But if we multiplied everything by 10, All right, so if you're talking about much bigger numbers here, so that your final assessed taxable income was actually, let's say, 4 million rand, then of course you need to be using the rule that applies to taxable income exceeding 1 million, which means that your second estimate can be not less than 80% of your final assessed taxable income. If that's 4 million, then your second estimate can't be less than 3.2 million. If you put it in at naught on the basis that you had this assessed loss brought forward, then you would be underestimating your taxable income and you're going to end up with underestimate penalties. Okay, so the point that I really want to make without getting bogged down in numbers specifically is that you do need to think about this limitation on the assessed loss set-off when you do your provisional tax estimates of taxable income. Does this impact on the deferred tax calculation? Yes, I would imagine that it would, because obviously in terms of the deferred tax calculation, it's still going to be timing differences that are going to reverse in the ensuing years, because you're not going to lose this altogether. It's just a timing issue. So it won't impact on the balance, but the rate, of course, is going to affect your deferred tax calculation, that you're looking at the 27 as opposed to the 28%. Okay, hope that does help you there. Right, so just to conclude on the reduction in the company tax rate, although there's the benefit of the tax rate then reducing from 28 down to 27%, it is being offset by these tax-based broadening measures, and especially I think the one that is going to affect many people is, and many companies, it only applies to companies, does not apply to trusts, does not apply to individuals, but many companies will be affected by the limitation on the assessed loss set-off. So please just bear that in mind in terms of your forecasting and also with your provisional returns and thinking about how that's going to impact on your cash flow going forward. Right, then let's move on to some of the other amendments. Now we get into some definitions that are being amended. And so we are moving into the Taxation Laws Amendment Bill now and looking at some definitions that are being amended here. The first one is looking at the definition of a retirement annuity fund, and it links to this concept of being able to transfer an interest in a retirement fund. Now, as I'm no doubt you are well aware, in fact, it goes back about over the last 10 years or so, we've been seeing a wave of amendments dealing with the retirement fund industry and dealing specifically, think about Section 11F, how that was changed. And then we had the compulsory annuitization that was introduced, although that only took effect from the 1st of March, 2021. But the idea there was that once we moved into compulsory annuitization across all three types of funds, it means that all three types of funds, pension, provident, retirement annuity, and the relevant preservation funds, they all operate on a pretty much level playing field. And so there's greater ability for members of funds to transfer from one type of retirement fund to another. And if you look at preservation funds, take the third bullet point here, members of a preservation fund are not restricted regarding transfers into other funds. But when we look at the definition of retirement annuity fund, although it should allow people to transfer from one fund to another, there is a limitation because of the way that the definition is worded. And so it really comes down to imperfect wording that they now have to correct, because it's been pointed out that you might have members that have perhaps more than one contract in a particular retirement annuity fund, and they may wish to transfer one or more, maybe part or all of their interest from a retirement annuity fund to another retirement fund. But because of the current wording of the definition, which I'll show you on the next slide, there's an anomaly, all right, that seems to prevent transfer of part of an interest. You can only transfer a total interest. And so they want to address this anomaly, change the definition to ensure that members are allowed to transfer from a retirement annuity fund to another type of retirement fund or another type of retirement annuity fund. And they say subject to certain conditions aimed at ensuring that the current de minimis thresholds are not contravened. Now, of course, those de minimis thresholds if you think about it, we have the de minimis threshold that applies to the amount available to purchase an annuity. So we have the limitations that exist in the definitions of pension, provident, retirement, annuity fund to say that you have this compulsory annuitization, but there must be at least 247,500. If we take 2/3 of that amount, 165,000 must be available to purchase an annuity. On the assumption that you could take 1/3 as a lump sum, 2/3 to purchase an annuity, you must have that minimum amount to purchase an annuity in order to make things viable. If you have too little capital to buy an annuity, it becomes non-viable from a financial point of view. So we've got those de minimis thresholds at 247,500, 2/3 of that, 165,000. Now, when you look at the amendment to this definition of retirement annuity fund, you will see that they say here that the amendment that's coming in is that they're adding this extra little subparagraph to the definition, saying that the rules of the fund may provide that, and there's all these other ones that come in, and now they've added this that says may provide for the transfer of any member's interest. And it used to say total interest, and they're taking that word total out, all right? And so it'll be, you can transfer any member's interest from an approved retirement annuity fund into another approved retirement fund. Okay, so that's where you can see the concession that you don't have to transfer your whole interest, you can transfer part of your interest, but then you come into these de minimis amounts. Now, you'll see the de minimis amount that they refer to here is different to the 247,500 or the 165,000 that I mentioned, and I'll come back to that. There is a link between these numbers, and I'll explain it just now. But let me just point out this de minimis amount for now. What they're saying is that there's two provisos here, and the second proviso has two paragraphs to it. The first proviso says that if you're going to have a transfer into another fund, the value of each contract being transferred must exceed 371,250. All right. So whatever you transfer from one retirement annuity fund to another fund, you must be taking out, you must be transferring more than 371,250. And then the next proviso basically says what you're leaving behind. If you're transferring part of your interest, the value of your remaining interest must also exceed 371,250. Okay, so basically they're anticipating there that you must have at least basically 742,500 available if you're going to transfer. In fact, it's and R2, right? Because each one of these must exceed. So it's 371,251 and 371,251. So they're anticipating you must have available 742,502 Rand to be precise. That if you split that in half, you're leaving behind the minimum amount and you're taking at least the minimum amount. All right, anything less than that, and you could not transfer part of your interest. But all is not lost, because you can still transfer. If you had less than that 742,502 Rand, you could transfer as long as you transfer your total interest, because they say the provisions of the first proviso and paragraph 1 do not apply if the member's total interest is transferred. Okay, so if you had, let's say, 700,000 available, if you split that into two, you would only have 350,000 on each side, which is not meeting the de minimis amount. But you could transfer the whole amount of 750 into another fund, because these de minimis amounts do not apply. Now, I said I'll point out the link to you between these amounts and that 247,500. So the current definitions say that 2/3 of your total amount must exceed 165,000. In other words, the amount available to purchase an annuity must exceed 165,200. That's 2/3 of your total amount, which then by implication means that the total amount in the fund must be at least 247,500. Okay, so that the amount available to purchase an annuity meets the minimum amount. So that's the general rule that already applies. Now, if you take 247,500 multiplied by 3, you get indeed 742,500. which of course, if we add these two amounts together, comes to that 742,500. So it does link to the 247,500 that we currently have as the minimum amount available to purchase an annuity. But they originally set this amount quite a bit higher at 495,000. Through the comment process, it was agreed to reduce it, and they came back to this number over here. Right, so you can transfer as long as you meet these requirements around the de minimis amount, but the de minimis doesn't apply if you transfer at least 100% of your retirement interest. But of course, if you were in a retirement annuity fund and your balance in the fund was less than 247,500, then you would be able to cash out of that fund because you don't have enough available to actually purchase a viable annuity. Okay, so there's a number of different de minimis amounts that you need to be thinking about. Right, so that's in terms of transferring from a retirement annuity fund. Then the other amendment is an amendment to the definitions of pension fund and retirement annuity fund. And this is to consider the protection of vested rights if a person transfers to a public sector fund. And it links to this concept of the compulsory annuitization, which came into effect on the 1st of March 2021. I mentioned that earlier. And there was the protection of vested rights. So if a person was a member of a provident fund, and they had already reached the age of 55 on this implementation date, then they were not affected by the compulsory annuitization. That's the protection of vested rights that they're talking about here. So that member, when they, let's say they were 56 on the 1st of March 2021, and they're going to retire when they get to 65, which is 9 years' time, and they were a member of a provident fund, when they retire from that provident fund, they can still take the whole amount as a lump sum. They're not affected by the compulsory annuitization. Right, so that's the protection of vested rights. But then you have this technicality where you perhaps have a member who is going to transfer from one fund to another. Are they going to carry that protection of vested rights with them? And they've discovered that when you look at these definitions of pension fund and provident fund, the protection of vested rights is forfeited if you transfer from a pension or provident to a public sector fund, because it doesn't make reference to that protection of vested rights, etc. So they need to amend those definitions to make sure that those vested rights are protected. So that's the amendment that they're doing there. And so it'll deal specifically where a person transfers into a public sector fund. Then we've got another amendment, a technical correction, also amending just because the wording didn't really achieve the objective. And this is in the definition of living annuity in section 1. Now, again, linking back to this change to the retirement system, moving into the compulsory annuitization for all three types of funds, and linked to that, the idea that there would be certain flexibility. So we had flexibility introduced in terms of being able to transfer from one fund to another. Another element of flexibility was in terms of the type of annuity that one could take on retirement. And we saw these amendments coming through last year, which would ensure that you basically have three choices. Either your retirement fund could pay you an annuity directly out of that compulsory annuitization aspect, or that retirement fund could go in and purchase an annuity from an insurance company, which would then flow through to the member, or the member could actually go and buy their own living annuity. And so there's those three options that are available. However, when you look at the definition of living annuity, because of the wording that exists at the moment, it creates an anomaly which tends to indicate that the person has to take an annuity from the same fund that they were a member of when they took their retirement. And so they're having to address this anomaly to clarify that the living annuity could be provided from a different fund. And if you look at the wording of the, I've taken it out here. Okay, I had this on my previous version of slides, sorry about that. But when you look at the wording of the definition of living annuity, so it currently talks about an annuity from that fund, which indicates that it's a fund that a person was a member of at the time that they retired. And now they're taking out the word that and they're rather saying any. So it's going to be an annuity from any fund, all right, not necessarily the fund that the person was a member of on the date of retirement. So just correcting the wording of that definition. Okay, so those are the amendments to the definition. That's got nothing to do with the two-pot retirement system. Of course, this links very much to the previous wave of change dealing with compulsory annuitization and the flexibility that then came about following the compulsory annuitization. Right, let's then go on to the next amendment, also the Taxation Laws Amendment Bill. This is another amendment to Section 7B. Now, Section 7B, first of all, came in, it looked like a fairly innocuous provision, but it's turning out almost into a bit of an anti-avoidance provision, because Section 7B has a two-part effect to it. It affects both the employee and the employer. Often, we just focus on the employee. Now, of course, Section 7B, the issue is that when you pay variable remuneration paid by an employer to an employee, the employee is deemed to have accrued that amount only when it's actually paid. So we often just focus on that aspect and we say, okay, well, we defer that date of accrual until payment takes place. And so you would not have to withhold employees' tax until payment takes place when you are dealing with variable remuneration. And the timing of accrual is obviously when payment takes place. But I think the real impact of the other part of this provision is not often focused on, and that is that the timing also affects the employer. That if you have an amount of variable remuneration that is paid, then that amount only constitutes expenditure incurred by the employer on the actual date of payment as well. And I'm not sure that many employers have properly thought this through in terms of their systems. Because when you talk about a tax liability for a year of assessment, timing is everything. We work out tax liability for that year of assessment, and that means that as a taxpayer, you can only deduct expenditure that has been incurred during that year of assessment, right? Yes, and allowances that you are entitled to for that year of assessment. You don't have a choice in terms of the timing of that expenditure incurred. So it goes back to the, your normal Section 11A general deduction formula, expenditure actually incurred in the production of income, et cetera, et cetera. So the key thing is, has that expenditure actually been incurred during that year of assessment? Now, if you are dealing with, let's say, a February year end, if you have variable remuneration not actually paid by the end of February, but you know that you have an obligation to pay the remuneration, but let's say it's a bonus and it's linked to a percentage of the company's profits or percentage of sales or whatever, and you can only finalize that amount maybe 3 or 4 months after year end. And so you then, let's say in June or July, you are able to quantify what the amount of that remuneration is, and you then pay it in perhaps the August payroll, right? So Section 7B tells us that the employee, that amount is deemed to only accrue in August when it's paid, and only subject to employees' tax in that month. And of course, it's deemed to accrue in that month to the employee. It comes into gross income of the employee at that time. So in other words, in the following year of assessment. If the employer also had a February year end, and you would probably have an accrual for accounting purposes, you would accrue that expenditure at the end of February. But what Section 7B is saying is that you cannot deduct that for tax purposes. You can only deduct it in the following year of assessment when payment is actually made. So the question is, as an employer, do you have accounting systems that properly identify when you are paying variable remuneration, and you make sure that you only deduct that variable remuneration in the year of assessment when payment is actually made? So not according to the accounting principle that would recognize the expenditure when it is incurred, when you basically know there's an obligation to make that payment, and you're going to try and quantify it as best as possible. But you can't deduct it for tax purposes at that point. You can only deduct it when it's actually paid. So you have to have systems suitable to be able to identify variable remuneration. Now, obviously, SARS is looking very carefully at this, and it tells me that they must be finding instances of employers who are claiming deductions before SARS considers that they're entitled to claim those deductions. They're claiming deductions in the wrong year of assessment. Not only that, SARS is identifying remuneration that they think should come into this definition because they want to apply the timing application of Section 7B. Because when you look at the amendment that they want to bring through this year, clearly they are wanting to expand the scope of Section 7B. So they're thinking that there's more remuneration that should come within the scope. Now, at the moment, we have variable remuneration actually defined in Section 7B1. And it's defined to mean, it says in 7B1, it says variable remuneration means. And then it lists A, B, C, D, E, F. We currently have 6 little paragraphs. And these paragraphs have been added on to over the last few years as National Treasury with SARS has identified that there's more remuneration that needs to come under this banner. And so we have things like overtime pay, bonuses, or commission. That's what goes into paragraph A. That was the original scope of Section 7B. And then they added on allowances or advances paid for transport expenses in terms of Section 8(1)(b). And then they talk about leave pay. Then they added on, I think last year or the year before, any amount paid as a night shift or a standby allowance. So those two were added on. And then they added on any amount paid by way of a reimbursement. So that's where you're reimbursing somebody on, let's say, a rate per kilometer, but you're paying more than the SARS official rate. And so that excess amount becomes taxable. All right, so those amounts are what comes into variable remuneration. So if you're paying any of those amounts of remuneration to an employee, you have to apply Section 7B for both the employee and the employer. And then they identified in the budget speech that they had found that there's another amount, another type of remuneration that they want to bring in within the scope here. And they said this amount links to payments that are not necessarily covered as a bonus or commission, but there are payments that are linked to the employee's work performance. So you see how they're trying to broaden the scope of this provision here. Initially, they spoke about this as an amount linked to units produced. That was what was in the draft bill. But then after discussion through the comment process, they've then changed the wording. And so they've added on now paragraph G, the 7th paragraph, to this definition of variable remuneration. And it reads any amount of remuneration as defined in the 4th schedule, other than a bonus, because that's already covered in subparagraph A. And so any other amount that is determined based on the employee's work performance. All right, so that's what comes in here. Any amount based on the employee's work performance. Then it does not accrue, nor is the expenditure incurred upfront. The timing of that happens when the amount is actually paid. So for both the employee and the employer. All right, so that expands the definition of variable remuneration even further. Then the other amendment that they've brought in is a more practical one, and this they've brought into Section 7B2, which talks about the fact that the amount is only accruing to the employee and incurred by the employer when it's actually paid. But then there's a proviso that's been added now to say that if the employee dies before the actual date of payment, the amount is deemed to accrue and constitutes expenditure incurred by the employer on the day immediately prior to the employee's death. So that links to the issue that when a person dies, your year of assessment ends on the date of death, right? So if we had an amount, let's go back to our February year end, and let's say that there was a bonus that was payable, but it was only actually determined finally the amount, and it was only paid in August, okay? So if this employee died in July, you've got a year of assessment that ends at the end of July. Now, for the year of assessment ended February of the previous year, this amount was not brought into the person's remuneration or gross income because it was deemed to have not yet accrued. But it accrues on the date of payment under the current rules, all right, which means that it then accrues in August, but the person dies in July. So then you have that practical issue. Does that amount then come into the deceased estate? And how does that work with the withholding of employees' tax by the employer? So obviously it creates a bit of a practical dilemma there. And so with this amendment, it's now deemed to accrue immediately before the date of death. And remember that the employer also incurs the expenditure then on that same day, immediately before the date of death. And that means the employer can then withhold the employee's tax, and it's brought into the taxable income for the year of assessment ending on the date of death of the employee. All right, so both of these amendments come into operation from the 1st of March next year, and they apply in respective amounts accrued or expenditure incurred on or after that date. Let me just see the questions that are coming through here. If a salary is not paid but credited to a shareholder's loan account, will this fall into Section 7B? No, not necessarily. If it's a fixed amount of a salary where you know the amount, because in order to see whether it comes into Section 7B, you would have to look at that definition of variable remuneration, right? It all hinges around that definition. And so variable remuneration does not include a normal salary. It includes overtime pay, bonus commission, various allowances, and so on. So if it's a straight or fixed salary, the fact that it's credited to the shareholder's loan account does not in itself bring it within the ambit of Section 7B. And then we say, if you include the amount in the February payroll and pay over the PAYE and allocate the balance, well, no, you see, this is the important aspect of Section 7B, is that you don't have a choice as to whether to apply the timing application or not. If an amount comes into the definition of variable remuneration, you have to deal with it according to the timing rules of Section 7B. All right, so that's why it's really important to be able to identify when you are paying something that comes into the definition of variable remuneration, because you have to ensure then that you apply the timing rule, that the amount only accrues to the employee and its expenditure only incurred by the employer when it is actually paid. Whenever that might be, it might be in the next year or probably a year or two later. It just depends on the circumstances, okay? But the key thing is that it's not optional, it's mandatory. If you're dealing with variable remuneration, you have to apply Section 7B. And looking at the amount of attention that has been given to Section 7B over the last few years with these amendments coming through, it seems to me that this is something that SARS does like to look at with employers, looking at the timing of their deduction. Yes, they look at the timing of the employee's tax and that as well, but I think they are making a lot of money out of looking at the timing of the deduction, because I think many employers are deducting the expenditure not in the year of assessment when it's actually incurred, according to Section 7B. Now, let me just explore that a little bit further. If the employer did claim the deduction in year one, but according to Section 7B, you should only be claiming the deduction in year two. So in year one, you've effectively got an understatement of taxable income because you're claiming a deduction that you're not actually entitled to, all right? And then in year two, you haven't claimed a deduction that you should be claiming. So you would have to then do the amendment of your taxable income in year two. But you're still going to end up with a problem in year one, that you've got the understatement of taxable income and with the consequent understatement penalties. And the whole thing just gets really messy. So you need to make sure that you have accounting system in place that is going to identify when you have variable remuneration and that you do get the timing correct in terms of the employee's tax and in terms of the deduction for the employer. All right. I think enough said on Section 7B. So we've dealt with those queries. I'm going to close that off. Let's then move to this amendment to Section 7C. All right. Now, Section 7C, of course, is the deemed donation provision that arises when you have got a low interest loan advanced to a trust or to a company owned by a trust. And then they expanded that also to also apply when you've got such a loan that is transferred, you've got a claim that is transferred, and also even further, where you've got a company owned by a trust that issues preference shares, and then somebody subscribes for the preference shares, and the dividends paid are less than what the interest would be if calculated at the official rate of interest. So you've actually got those different circumstances now where Section 7 applies. Now, the key thing is that Section 7 applies when there is a trust involved and there's an individual behind the loan, either to the trust or to the company owned by the trust effectively. And of course, the impact of Section 7C is really found in the subsection 3, which tells us that when you've got the loan advanced at interest less than the official rate of interest, okay, then the difference is what's going to give rise to your donation. So that's what this is saying here. The difference in interest is treated as a donation. And it's a donation made to the trust, all right, albeit that you might have a loan to a company owned by a trust, or you might have a company owned by a trust that issues preference shares, all right, but the idea is that it's the individual behind the loan who's treated as making a donation to the trust. So that's already there. That's already in Section 7C3. But the timing of the donation, currently, it is that the donation is deemed to be made on the last day of the year of assessment of the trust. And now they're adding in these words, or company. And so that could change the timing of the donation from the end of February to a different date. Because if, for example, you've got a company that has a junior end, all right, and you've got a person who's advancing a loan, let's say an individual advancing an interest-free loan to a company owned by a trust, you would then have to work out the interest differential on that loan, looking at the year of assessment of the company. And albeit that you still regard it as making a donation to the trust, it's going to be subject to donations tax at the 20% and so on. But your timing of the donation is deemed to be made on the last day of the year of assessment of the company. All right. Whereas if you're making a loan directly to a trust, then your donation is deemed to be made on the last day of the year of assessment of the trust. Okay, so yeah, it just adds in that extra bit of complexity, but maybe it simplifies life in some respects in that you can run that calculation across the year of assessment of the company. Okay, so this amendment, you'll see there's no specific amendment date, effective date, and that means that it takes the general effective date, which will be the date of promulgation of the Taxation Laws Amendment Act, and that in all likelihood will be sometime in January next year. Now, let's just go back. I see I have a question. What about a bonus that is declared, but not physically paid, but rather accounted as repayment of a loan account? Well, the thing is, look, whether you pay it or you charge a loan account, that's regarded as an amount that is paid, all right? So if you're debiting it to the loan account, that is regarded as paid. We've got case law to tell us that. So I'm not sure why we are asking this. A bonus, all right, a bonus comes into the definition of variable remuneration. So the tax incidence is when it's actually paid, but there is case law to say that when it's accounted to an actual loan account, as long as it is going to a loan account and that's regarded as the payment, then you could say that that is then when it is paid. Okay. Right. Let's have a look at the next amendment. Right. So this is an amendment to Section 10(1)(I), which is your local interest exemption. The local interest exemption only applies to individuals and deceased estates, and it is your exemption of up to 34,500 if you're over the age of 65, or 23,800 if you are under the age of 65. Now, what this is speaking to, this particular amendment, is when a person has a period of assessment of less than 12 months. We've never apportioned this fixed amount of the exemption. So if a person, for example, died at the end of March, they only had a 1 month year of assessment, technically you could still take the whole amount of this exemption for that period. Similarly, for a deceased estate coming into existence, maybe it comes into existence on the 1st of February, and you would still have the whole amount of 23,800 available to that deceased estate. Of course, what they're also talking to specifically when they explained this amendment was somebody who ceases to be a resident during the year. Now, somebody who ceases to be a resident during the year, their year of assessment is deemed to end the day before they cease to be a resident. So if you had somebody who flew out of South Africa, let's say they're going to fly out on the 1st of December, they're leaving, they're never coming back, this ceases to be their real and permanent home and they cease to be a resident, if that is the case, all right, that they cease to be a resident on the 1st of December, that person would have a year of assessment that runs from the 1st of March up to the end of November. And for that year of assessment, they're taxed as a resident. And then they have technically another year of assessment that comes into existence from the 1st of December through to the end of February, and they would be taxed as a non-resident. Now, practically, up until now, SARS hasn't really done this on their systems. They've just taxed somebody for the whole year, and they've just said, right, you're a resident for 9 months of that year, and you were a non-resident for 3 months of that year. But technically, there's supposed to be, according to the legislation, a year of assessment that ends immediately before the person ceases to be a resident. And of course, we also see the Section 9H exit tax. That person is deemed to have disposed of all of their assets immediately before they cease to be a resident. Okay, so technically there is supposed to be a year of assessment that ends, let's say 30th of November in my example. Going forward, SARS has said that they are going to update their systems to actually have these 2 clear years of assessment. And then what they want to ensure is that we actually apportion the amount of this exemption. So you can't get a double exemption if, for example, you have a year of assessment ending end of November, taxed as a resident, and so you would then, let's say you're over the age of 65, you get the 34,000 exemption, and then for the next 3-month period, you're taxed as a non-resident, but if you're earning SA source interest, that would come into your gross income. You might get the non-resident interest exemption under 10(1)H, but it's unlikely in that first year, in the timing that I've referred to, because you don't get it if you've spent more than 183 days in South Africa in the 12 months leading up to the date on which the interest accrues. So it's unlikely you're going to get the 10(1)H exemption as a non-resident for that period. Then you're looking at this 10(1)I exemption. But it would be unfair, SARS says, to have a double portion of that exemption in that circumstance. Now, when you look at this amendment, they're saying any person's year of assessment less than 12 months. So it's not only applying where a person ceases to be a resident, it would also apply in any other circumstance, and specifically if a person dies during the year. You would have to then apportion this exemption according to the number of days in the year of assessment that bears to 365 days. And this amendment, where you have to apportion the exemption, comes into operation from the 1st of March 2023 and applies in respect of years of assessment commencing on or after that date. So it's going to come into effect for next year's year of assessment. So just a really important one to bear in mind. Linked to that, they also wanted to make a similar exemption to the annual exclusion in paragraph 5 of the 8th schedule. And in the draft legislation, they also looked at apportioning this annual exclusion. But then during the comment process, they backed away from that, and they actually changed what was in the initial version of the bill. They changed what came through in the final version of the bill. And basically, they're saying here that paragraph 5(1) of the 8th schedule will have a proviso added to it to say that if a person's year of assessment is less than 12 months, the annual exclusion over the whole 12-month period, beginning in March and ending at the end of February, cannot exceed 40,000 Rand. So basically, over a 12-month period, the same person cannot get an annual exclusion of more than 40,000 Rand. So if you have a person who ceases to be a resident during the year, going back to my example, ceases to be a resident 1st of December, so their year of assessment ends 30th of November, they are taxed as a resident for that period up to the end of November, and then they're taxed as a non-resident in the following period. But in the period where they're taxed as a resident, the year of assessment ending 30th of November, they've got that deemed disposal that happens on the 30th of November. They're deemed to have disposed of all of their assets other than effectively immovable property or assets connected to a permanent establishment in South Africa. So they could have a significant capital gain that comes through that exit tax at the end of November, but they then could set off any amount up to 40,000 against that capital gain. Of course, if they utilize the full 40,000 against the capital gain that arose on the 30th of November, and let's say we then go to the next 3-month period where they're taxed as a non-resident, if they sold a South African property during that time, they might then have a capital gain on that disposal. But if they've already used the 40,000, then they would have no further annual exclusion to use in the following period. Or they can choose, all right, they might not take any amount of the annual exclusion against their deemed disposal because maybe they don't really have any other assets other than their immovable property. Maybe they keep the whole 40,000 to utilize in the following 3-month period when they sell their immovable property, and then they can use that 40,000 Rand. So you can choose how much you want to use, but you just cannot use more than 40,000 over that 12-month period. Okay. And that also coming into effect for next tax year, years of assessment commencing on or after 1 March 2023. All right, so there's no specific apportionment, but you just can't get more than 40,000 over a 12-month period. Now, there's often the question that says, how does this impact the 300,000 annual exclusion in the year of death? Now, that 300,000 annual exclusion comes through paragraph 5, subparagraph 2. This amendment is a proviso to subparagraph 1 of paragraph 5. So it's not going to affect that 300,000. Okay, I mean, the 300,000 is an annual exclusion that's available in the year of death. So for that period ended up until the date of death. Then the deceased estate comes into effect, and then, of course, that deceased estate would look at the 400,000. It's a different exclusion that applies. It's got nothing to do with the 300,000. So this only affects the 40,000 Rand annual exclusion. Okay, so those are the amendments that come through for years of assessment less than 12 months. Then we get on to some business-related amendments. And this one talking about the wear and tear allowance, specifically on assets that are funded by way of a government grant. Now, government grants, if they are grants that are listed, it's a program listed in the 11th schedule, the grant is exempt in terms of section 12 capital P of the Income Tax Act. And then, of course, the idea is that any expenditure that is funded by way of that tax-free government grant should not get any tax deduction. And if the grant is used to purchase an asset, you should not be getting any tax allowance on that asset. And that's achieved through the provisions. And if you look at, for example, section 12C, section 12B, those kinds of allowance provisions, those allowances are based on the cost of an asset, which excludes any amount that is funded by way of a tax-free government grant. But the wear and tear allowance is a little different. It doesn't refer to the cost of an asset. A wear and tear allowance is based on the amount by which the value of an asset is reduced as a result of wear and tear. So at the moment, it doesn't exclude any assets funded by way of a tax-free government grant. And because it's not linked to cost, we don't have that exclusion that applies. So there's a bit of a loophole then in section 11A, which people would argue would enable them to claim the wear and tear allowance even on assets that are funded by way of a government grant. But National Treasury is saying that that was never the intention. And so now they are amending section 11E. They're adding this proviso, number 10, which says no allowance may be made on any machinery, plant, implement, utensil, or article acquired by the taxpayer as or with a government grant, as defined in section 12P. Right, so as being a government grant in kind, where you literally get the asset and that's coming through a tax-free government grant, or you're getting a grant and you're using that money to go and buy an asset. But however it works, if it's funded by way of a tax-free government grant, then you can't claim the wear and tear allowance. Now, it might be that you have been claiming a wear and tear allowance on a particular asset that was funded by way of a tax-free government grant. This, though, would have been already shut down, because you'll see here that this amendment is deemed to come into operation on the 29th of July 22, which was the date that the draft bill was released for public comment. And the amendment applies for years of assessment ending on or after that date. So a year of assessment ending effectively on or after, let's say, the 31st of July 2022, on or after that date. So if you've got a year of assessment that's going to end in February next year, well, you can't claim this wear and tear allowance at all in this year. Okay, so you might have been claiming it in the past, but you can no longer claim this wear and tear allowance. Then we move on to have a look at an amendment dealing with the debt benefit rules. Now, the debt benefit rules, we have covered these previously, quite complex. I'm just going to give you a brief overview of how they actually work. But debt benefit is looking at where the debtor in a debtor-creditor relationship, the debtor has derived a benefit because a debt has been effectively waived or compromised to some or greater extent. For example, if you have a debtor who borrows R1 million from a creditor and they use that R1 million to fund deductible expenditure, operating expenses, salaries and wages, something of that nature. They've claimed the tax deduction. They still owe the creditor the R1 million. If, for whatever reason, that creditor waives the right to recover that R1 million, the creditor obviously suffers a loss on that waiver. The debtor is benefiting to the extent of the waiver. And Section 19 and paragraph 12A of the 8th schedule seek to ensure that the benefit that is derived by that debtor is properly recognized for tax purposes. Now, it all hinges on what the debt was actually used for. In my example, if the debt, as I said just now, was used to fund tax deductible expenditure, if you then have that debt that is waived, you've got a debt benefit of R1 million. What was the debt used for? To fund tax deductible expenditure. And so Section 19 would then require that you recoup the past deductions. So actually, Section 19 requires the recognition of a Section 84A recoupment in the year that you get that debt benefit. It can also apply if the R1 million was used to fund the acquisition of an allowance asset. Let's say the asset cost R1 million and you've claimed Section 12C allowances on that asset. You still own the asset, but you fully claimed the allowances. Now you get that debt benefit. Well, what you would do there, if you use the debt to fund the acquisition of a capital asset, you'd first look at 12A and you would reduce the base cost of the asset. But if I no longer have any base cost because I've fully written off that asset, I can't write it down any further. So then we look at Section 19, which then creates this recoupment of your past allowances. All right, so you've got your recoupment, and paragraph 12A requires that you reduce the base cost of the asset. Now, of course, there is a complication that arises. What if you get a debt benefit this year because you've got a debt that has been waived or compromised, but you no longer hold the asset that debt funded? You sold the asset in a previous year. So the debt funded the acquisition of the asset, but then you sold the asset, you still have the debt, and now the debt is waived. So you have a debt benefit in the current year, but the asset has already been disposed of. So you can't apply paragraph 12A to reduce the base cost of the asset because you don't have the asset anymore. What about Section 19? Well, again, you don't have the asset anymore, but we've got a special rule that comes through Section 19.6 Cap A that says that where the debt funded the allowance asset that was disposed of in a previous year of assessment, you must basically recalculate the recoupment. So when you sold this asset last year, you didn't know about the debt benefit at that stage, but if you sold the asset and you recouped your past allowances, you would have recognized that recoupment last year. Now that you have the debt benefit, how would that affect that recoupment had you known about the debt benefit in that year? So you have to effectively go back and recalculate that recoupment. And of course, indications are it would give rise to a greater recoupment because you've now got this debt benefit. And so that additional recoupment has to be recognized in the year that the debt benefit arises. Okay, so that sounds pretty complicated as it is. But they found that Section 19.6A actually has a massive loophole, an unintended anomaly, because the way that Section 19.6A is worded, and I'll show you the wording just now, but it specifically talks about where the asset was disposed of in a previous year of assessment and there was a recoupment on that disposal. And so it doesn't apply. It completely overlooks the situation where you might have had an asset disposed of in a previous year at a loss, either a capital loss or maybe you were able to get the 11.0 scrapping allowance. And they're saying, well, surely Section 19.6A should apply whether you disposed of that asset for a loss or there was a recoupment on that disposal. Okay, so at the moment it's leaving out a whole lot of assets that should really be considered. And so this amendment is going to try and clarify that this provision does indeed trigger a recoupment in the year that the debt benefit arises, where the asset was sold in a previous year, whether the asset was sold at a profit or a loss, basically. Okay, so we'll see that the amendment that's going to come through. I just want to mention that this amendment will take effect from the 1st of January 2023 and apply for years of assessment commencing on or after that date. Bearing in mind that there's a massive loophole there right now, I'm surprised that they didn't say years of assessment ending on or after that date, but be that as it may, it's only coming into effect for years of assessment commencing on or after 1 January 2023. So let's have a look and see what this amendment actually looks like. If you look at the first part, this is the wording that is already there. It says in section 19.6a, where you've got a debt benefit in a year of assessment in respect of a debt owed by a person as contemplated in section 19.2, and the amount of the debt is owed to, the debt was used basically to fund expenditure to acquire an allowance asset. I think I'm just going to mute that noise coming through so you don't keep having interruptions there. All right, so you've got a debt benefit that's arising in the current year. What was the debt used for? It funded the acquisition of an allowance asset, and that asset was disposed of in any previous year of assessment. So what the wording said before, it said the person must, and you'll see here, it only talks about where there's a recoupment. It said if the amount determined on the disposal as a recovery or recoupment of a deduction or allowance is less than the amount that would have been so determined had the debt benefit been taken into account, then you must recalculate and treat the difference as a recovery or recoupment in the year that the debt benefit arises. So that part's now been taken out because it only talks about where the asset was disposed of for a recoupment. And they replaced it with this. Okay, so now it says the person must treat the debt benefit in respect of the debt to the extent that any deduction or allowance was granted on that asset, and the debt benefit basically cannot be applied to reduce the base cost of the asset because the asset was sold in a previous year. That amount is going to be recognized as a recoupment, but if you have already recognized any amount or previously as a recoupment, then you take that out, so you're not going to double count for any recoupment. Okay, so that then caters for the situation whether you sold that asset at a profit or a loss in the previous year. So let's just look at an example of how this would work if you sold the asset for a loss in the previous year. Let's say that you had a company X that purchased plant and machinery costing 2 million in year one. And in year one, they got their 40% section 12C allowance, 800,000. In year two, they got a 20% 12C allowance of 400,000. So at that stage, total allowance is 1.2 million, original cost 2 million. You've got a tax value, a remaining tax value of 800,000, right? They then sold the asset for 700,000. So there you can see that they've sold the asset at a loss and they get the 11.0 scrapping allowance. That was in year two. They still owed the amount of 2 million rand to the creditor. Why? So then in year three, let's assume that they went into business rescue, and why waived? Let's just assume they waived the whole debt of 2 million rand. So we've got a debt benefit that arises in year three. Let's assume that none of the exclusions applies, and so we have to recognize that debt benefit in accordance with section 19 and paragraph 12A. So paragraph 12A says that you have to reduce the base cost of the asset. We can't do that because we already sold the asset in year two. So we then look at section 19.6A. And what section 19.6A will require us to do is we say there's a debt benefit in the current year, which has not reduced the base cost of the asset because the asset was already disposed of. So the amount of that debt benefit up to the amount of whatever deductions and allowances we've previously claimed on that asset. So we claimed 800,000 and 400,000 under section 12C, and we claimed 100,000 last year as a scrapping allowance under Section 11O. So our total deductions and allowances 1.3 million. So we're going to recognize that as a recoupment, and you would then deduct any amount previously recognized. In this case, there was no previous recoupment. That's there to cater for if we had sold the asset for a recoupment in a previous year, then of course you're not going to recognize that again. All right, so in this particular case, you'd have to recognize this recoupment of 1.3 million. Without this amendment to Section 19.6a, one could argue, I mean, it might be a little aggressive, but you could argue that the previous wording of Section 19.6a did not bring this disposal or this debt benefit into the scope, and so there would be nothing to be recognized here. But as I say, it comes down to the interpretation. But just to make sure that there's no argument, they've amended this to make sure that you include your recoupment in the current year, even when you sold the asset in a previous year and you sold it at a loss. Okay, then let me just have a look at the next amendment. I'm just going to cover this one and then we'll take a 15-minute tea break. So this is Section 24, the debtor's allowance. The debtor's allowance applies when you've got a taxpayer who sells goods on credit. They have to include the whole amount that accrues at the time of the sale. But if they qualify for the Section 24 allowance, then they would get the deduction for that allowance. Of course, whatever you deduct in year one, you'd have to add back in year two. Now, there is a discretion available to the commissioner in terms of granting this allowance, but there was an argument to say that it wouldn't apply to lay-by agreements. And lay-by agreements is a very big feature of the South African retail environment. And the reason why one could argue that Section 24 would not apply to lay-by agreements is because it only applies where the agreement extends for more than 12 months, and at least 25% is going to only of the selling price is only going to be recovered in a subsequent year of assessment. And so the retail industry was concerned that lay-by agreements were not considered in Section 24, and they wanted them to be brought within the scope. And so they've now made this amendment by adding in another subparagraph. So the main 24.2 is the existing subparagraph, which they added in words to say that will not apply to lay-by agreements. And then they've got a specific provision that applies to lay-by agreements as considered in the Consumer Protection Act. All right, and then the allowance would apply in that circumstance, subject to the condition that whatever allowance you claim in year one, you would have to add back in the following year. So this extension of Section 24 to apply to lay-by agreements comes into operation from the 1st of January 23 and applies in respective years of assessment ending. You see here, they are saying ending on or after that date. And that was following representation from commentators who called for an early implementation date. Initially, they said years of assessment commencing on or after this date, but to make it have effect more immediately, they now say it's going to come into operation for years of assessment ending on or after 1 January 2023. All right, so that's the amendment to Section 24. It's a good place to take a tea break because we're going to get onto some fairly complex corporate tax discussions after the tea break. So it is 15:35, let's call it now. We'll take a 15-minute tea break, and that means we will come back at 10 to 4, 15:50. Okay, see you just now. Enjoy the tea. I hope your electricity is working. We'll see you at 15:50. Right. Hi, everyone. I think we should get started because I'm seeing, sorry, Ian, that you're going to be having to lose us because of load shedding. And I think let's get started in case there's anybody else who's going to have load shedding kicking in at 4 o'clock. I'm sure there will be a recording available, so you can then catch up on the recording later. But it's never as good as having the live thing, right? Okay, but let's carry on then. And so now we move, as I warned you, into some fairly complex corporate tax issues. The first one deals with Section 45 intragroup transactions. And of course, Section 45 deals with, as the name indicates, when you have an intragroup transaction, you have a disposal of assets from one company to another, and both companies are part of the same group of companies as defined in Section 41. Now, the issue there is that you would have a tax neutral disposal. So company A sells assets to company B. Let's say that asset originally cost R1 million, written down to 200,000. It now gets sold to company B. B just takes over that asset and continues with the allowances on that asset. So B effectively just steps into the shoes of A. And it's supposedly a seamless transaction as far as tax is concerned. And that's the whole idea, is that you should not have tax recoupments and capital gains and so on arising when you have a simple intra-group transaction. Okay, so the benefit is this tax neutral transfer of assets, but then to counteract possible abuse of this provision, they have a number of anti-avoidance rules. And these anti-avoidance rules are quite complex, but in essence, they are addressing, for example, company A, company B, if they cease to be part of the same group of companies, and they put a period of 6 years there. So if they de-group within 6 years, then there's a clawback provision that is triggered. And so that would, discourage companies from making use of the intragroup transaction and then de-grouping. Another one is if the asset is sold outside of the group within 18 months, then there can be a similar type of clawback of a tax benefit. So we already have those anti-avoidance provisions. Now, another type of anti-avoidance provision that was introduced sort of more recently, these are also provisions that are sort of constantly under development. All right, but this one is what they call the nil base cost rule. And that is where we have assets sold, let's say, from company A to company B. Company A is the transferor company. Company B is the transferee company. But company B doesn't just pay for that asset. Let's say it was worth 200,000. They don't pay for the asset. They actually, that transaction is funded through either the issue of debt or the issue of non-equity shares other than equity shares, so like preference shares. All right. So in that case, if you visualize this, you got the assets sold from company A to company B. They're part of the same group of companies. But then the company B issues preference shares, all right, to fund the acquisition of that asset. So company A, instead of having the asset, it now has another asset called preference shares, right? Now, in that situation, company A, the transferor company, is deemed to have a nil base cost of that asset. So those preference shares that they now hold have a nil base cost. That comes through the application of Section 45(3) Cap A. But then it was recognized that, hold on, you can't just have a nil base cost indefinitely, because then you end up with double penalty effectively, because we've already seen that there are clawback provisions if those companies de-group within 6 years. And there's also a similar clawback provision if the assets are sold outside of the group within 18 months. And so it was recognized that, okay, you can have this nil base cost initially, but there must be circumstances where the nil base cost reverses, effectively back to what it should have been initially. So you ignore the nil base cost rule. In 2021, there was an amendment made where they inserted Section 45(3) Cap B, and that effectively listed 3 circumstances where the nil base cost rule would be ignored. And the first one, it said, if the transferor and transferee company cease to be part of the same group of companies, all right, or after the expiration of 6 years, because then you're out of that kind of risk period of 6 years, or if the asset is unsold outside of the group of companies within 18 months. Now, that's the original asset sold in my example from company A to company B. If company B sells that asset outside of the group within 18 months, then of course there's going to be tax consequences there. So you don't also have to have the punitive nil-based cost rule that applies in company A. So in those three circumstances, the nil-based cost would be ignored. That's in terms of last year's amendments. Then they thought actually perhaps there were more circumstances that they should be considering there where the nil-based cost would be reversed. And then after much discussion, they've basically put through an amendment which is very similar to what we currently have, but effectively, they've slightly reworded this first bullet point, talks about degrouping within 6 years, but is effectively saying pretty much the same thing. Or if you reach 6 years from the date of the initial asset transfer, then you're out of that risk period. So the nil-based cost reverses. And the third one, it previously said if the asset is unsold outside of the group within 18 months, and they've now reversed that. It's no longer within 18 months. It's at any stage if the asset is sold outside of the group, then that nil-based cost provision would reverse. Okay, so it's really tidying up, if one could say, the amendments that came through in 2021. And so the effective date is in line with the 2021 amendments, which took effect from the 1st of January 2022. Okay, of more impact is this definition of contributed tax capital. This is also being a huge discussion in the corporate tax community. Now, the significance of contributed tax capital. Contributed tax capital is effectively what the shareholders invest into a company. It's like your pure share capital, if we get back to the sort of old terminology. But we need to bear in mind that we're now working with a different Companies Act, the new, well, not so new, but new Companies Act compared to the old one. And under the new Companies Act, if I can put it that way, companies can change their capital structure. They can refund capital back to the shareholders and so on. Obviously, they can also do share buybacks. And so they can vary their capital. Now, from a tax perspective, we have this thing called contributed tax capital. It's something that only exists in the Income Tax Act, but essentially it's designed to measure, if I put it in very simple terms, what the shareholders have put into the company. And that means that if the company then repays part of that contributed tax capital, or maybe all of it, back to the shareholders, you measure this per class of shares. So if the company pays back some of that contributed tax capital back to the shareholders, that repayment of contributed tax capital is then not a dividend. It's excluded, specifically excluded from the definition of dividend. So what we see is that any amount transferred or applied by a company, or we could put in simple terms, paid by a company to the shareholders, is a dividend unless it's excluded because it is a return of contributed tax capital. Now, of course, whether an amount is a dividend or whether it is contributed tax capital has significantly different tax implications. An amount that goes to a shareholder that is a dividend, that dividend, of course, comes into the gross income of the shareholder. It's probably exempt in terms of Section 10(1)(k). But then, of course, you've got dividends tax payable at 20%, unless you have an exclusion, like dividends going from company to another resident company, or perhaps you've got a lower tax rate in terms of a double tax agreement. But in essence, if an amount is a dividend, it's going to be, let's say, subject to dividends tax, especially if it's going to a non-resident, and they seem to especially be concerned about amounts going to a non-resident, or amounts going to trusts or individuals, it's going to carry dividends tax. Whereas an amount that is a return of contributed tax capital is not a dividend, so it's not subject to dividends tax, but it will have capital gains tax implications in the hands of the shareholder. Now, if that shareholder, again, is a non-resident, chances are it won't have any capital gains tax implications because a non-resident is only subject to capital gains tax in South Africa on disposals of immovable property or assets connected to a permanent establishment. All right, so if you're dealing with a non-resident shareholder, contributed tax capital would probably have no tax impact for the shareholder. Now, let's get back to what's been happening. So when we look at the definition of dividend, which I've kind of briefly explained. We've also got a definition of contributed tax capital, and there's a proviso to that definition which seeks to ensure that any amount of contributed tax capital that is going back to a shareholder can never exceed that person's pro rata share according to their shareholding relative to the total shares in that class. So if you had contributed tax capital for a class of shares of R1 million, and let's say that there were 1,000 shares in issue, and you had a non-resident who held 20% of those shares, and if the company was, let's take it to the extreme, paying back that whole R1 million back to the shareholders, what's going back to each shareholder can never exceed their pro rata share of that contributed tax capital. Now, if you're doing a general payback of capital to shareholders and you're paying back pro rata to everybody, you're probably not going to have a problem there. But what happens if you do a share buyback and possibly you're only buying back some of the shares? All right, you're not returning to everybody. So then what's going back to a particular shareholder is not necessarily pro rata, because you're only buying back shares from that shareholder. So they're not getting the same as everybody else, if I can put it that way. There's also the issue around companies entering into various kinds of structures where they try and kind of inflate or overweight the amount of CTC that is going back to certain shareholders. So especially those shareholders who would be liable for dividends tax, like trusts, individuals, or non-residents, okay? They've got certain structures where they perhaps have a certain amount paid by the company back to the shareholders, let's say for a share buyback, and then they weight that more heavily as CTC for some, because they would be liable for dividends tax, so it's better for them to take more as a CTC and less as dividends. Now that, according to the normal proviso, the thinking is that it shouldn't happen, because any amount that goes back to the shareholders by way of CTC should never exceed that shareholder's pro rata holding in that particular class. But as I say, corporate transactions can sometimes be fairly complex. Now in 2021, they did make changes to the definition to clarify that all shareholders within the same class of shares should share equally, pro rata to their shareholding, when there's CTC that is being paid back to the shareholder. So if you have someone who holds 20% of the shares, what they're getting back by way of CTC can never be more than 20% of the total CTC for that class. But then there were some observations made, but what if it was a company, a listed company doing a general repurchase of shares, etc.? There must be a different consideration in that particular case. And so that proviso that they introduced last year specifically excluded a general repurchase of shares by listed companies. There was still further discussion around whether that amendment was acceptable or whether it still had negative implications for bona fide transactions. And so, bearing in mind that what we just saw on the Section 45 amendment took effect from the 1st of January 2022, this amendment to the definition was going to have effect from that same date, but they then pushed that out by a year. They delayed it to be effective from the 1st of January 23, and basically to give them more time to address the concerns of the commentators. But there was this amendment that went into the definition in the 2021 Taxation Laws Amendment Act, effective 1 January 23. Then they had another look at this and they said, actually, we are concerned about the impact of those amendments on legitimate business transactions. And so what the amendment is now is actually an amendment to the 2021 Taxation Laws Amendment Act. And they're saying, go to that act, take out what was there, and now replace it with this. And now you'll see there's no exclusion for general repurchase by listed companies and so on. It's a much more, a kind of a broad-based provision. It says that an amount transferred by a company must comprise a transfer of CTC only where. So it can only be CTC. And remember that the balance then, by definition, must be a dividend. So the return going back as contributed tax capital, it can only be CTC where the shares in a class of shares in respect of which there's a distribution or there's consideration for the acquisition, a share buyback, cancellation, redemption, paid or payable by that company. So looking at those shares in respect of which there is a share buyback or a distribution, they are each transferred an equal amount of CTC in respect of that class of shares. So it kind of recognizes that maybe not all of the shares in a particular class are participating in that buyback or that distribution, but the ones that are participating must get an equal pro rata share of CTC. And the amount of that transfer may not exceed the total amount of CTC divided by the total number of shares within that class. So it's going back to that issue around CTC pro rata to the person's shareholding, and all the shares that are participating must get an equal share of CTC. So it's trying to prevent this distortion of CTC and sort of keep CTC more limited so that we are not understating the dividend. So keeping the CTC limited, and the balance or whatever goes back to the shareholders by definition is a dividend. Now, what is interesting is because this is an amendment to the 2021 Taxation Laws Amendment Act. And so the effective date, they say here, is deemed to come into operation from the 19th of January, which is actually the promulgation date of that act. That was when it was promulgated. But remember that when we looked at the original wording in that act, it said it was effective from the 1st of January 2023. So it's a bit weird in that they're changing that act, which was effective from that date. That's when it was promulgated. The whole act was promulgated on that date. But this particular amendment must then take the same effective date as applied, which was the 1st of January 2023. So confusing around the effective date, but I submit that that is basically what the effective date would be. Right, then Graham has asked, any difference between a dividend these days before liquidation or as a liquidation dividend as part of the liquidation process? Yeah, so I mean, a dividend before liquidation, any amount distributed by a company is a dividend unless it is a return of CTC. So your sort of going concern dividend in the ordinary sense would be the whole amount paid by the company. But when you have a dividend that's paid as a liquidation dividend, you would have to actually analyze that company's, the capital, the CTC of that company, and what is left as your reserves. And basically your liquidation dividend would be partly a return of CTC, and then the balance would be a dividend. So during the liquidation process, you would have to go through that analysis. And then your final liquidation distribution, of course, what you also have is that the shareholder is deemed to have disposed of their shares, right? On when the liquidator announces that this is the final liquidation dividend. And of course, what is going back as a return of contributed tax capital is basically the proceeds on disposal of those shares. Is capital gains tax, Mervyn asks, is capital gains tax payable on a capital distribution? So if the company is paying a capital distribution, so it's not necessarily doing a share buyback, but is just returning some of the contributed tax capital back to the shareholder, then the requirement in terms of the 8th schedule, paragraph 76B and so on, is that the shareholder has to reduce the base cost of their share. So if the company pays CTC of 1,000 Rand back to the shareholder, if the shareholder's base cost of that share, so whatever the shareholder obviously paid for that share, let's say it was 1,000 Rand, then that base cost would be reduced down to nil. Okay, so initially you reduce the base cost. If your return of CTC exceeds the base cost, any excess immediately becomes a capital gain. Right, so I hope that clarifies. Yeah, so these issues around contributed tax capital and dividend are really important aspects of any tax implications for a company, and they are very complex. Right, let's then move on to the VAT amendments. Now, you'll see in the VAT amendments, I've kind of got two categories here. This first category are amendments that are what National Treasury calls reviewing Section 72 decisions. So these are amendments. If you think about Section 72, it was a provision initially that allowed SARS to vary the application of a VAT Act according to a ruling that was given to specific vendors. But then in 2019, Section 72 was substantially amended to basically say that, first of all, any rulings that had been given would cease to have effect from the 31st of December 2021. Just make sure I get that date right, December 2021. And then furthermore, anybody who wanted to apply for a ruling under Section 72, you could no longer apply individually, because it was felt that that was unconstitutional and there was a lack of transparency around the rulings that had been given. And so going forward, if you felt that the VAT Act didn't work for your particular business model in some respect, then you could apply for a ruling to vary the application of the VAT Act, but then you would have to apply with other people in the same industry, which practically might be difficult if you're having to approach your competitors and discuss how the VAT Act applies to you. But nonetheless, that is how Section 72 works. So in this process of the previous rulings falling away and new rulings being applied for under the new rules, this is what they're referring to as reviewing these Section 72 decisions. So what they're effectively saying is that whereas in the past there may have been specific rulings around how the VAT Act would apply in certain circumstances, going forward, some of those things could be incorporated into the VAT Act, which actually is not a bad idea, because it means that those rulings are not exclusive for the vendors who applied for them, but other people could see this in the VAT Act and say, well, I could also fall within the scope of that provision and I can make use of that particular variation, if you like. So this is what is coming through with these four things at the moment, is that we've got these four specific things being brought into the VAT Act. So the first one deals with the registration of certain foreign suppliers. They've got a new registration rule that will apply there, and I'll go into the detail just now. I'm just giving you an overview to start with. The next one deals with flash title sales and talking about the definition of enterprise in Section 1. And just to clarify, when we talk about flash title sales, this is something that happens in the import-export industry. It's got nothing to do with those little adverts that flash onto your screen when you're scrolling through Twitter or something like that, okay? Nothing to do with that. Flash title is talking about where you've got movable goods sold from a South African vendor, a registered vendor, to a non-registered, a non-resident, what we call qualifying purchaser. We call that QP1. The first step of the transaction. So it's a non-resident qualifying purchaser, and that QP1 immediately on-sells the same goods to another qualifying purchaser that we call QP2. Now, the question is, if you've got these goods, they're still situated in South Africa, but ownership has transferred. So you've got a South African vendor supplying to a non-resident QP1. So yes, you've got a vendor over here, the initial supplier, but should that QP1 register as a vendor? Because the goods are still here and they immediately on-sell those same goods to another qualifying purchaser. Now, clearly they had a ruling that said they didn't have to register. But now they've brought that into this amended definition of enterprise, which we'll have a look at just now. And then on pooling arrangements. So pooling arrangements, we currently have in Section 52, Section 52(1), which talks about pools under the Marketing of Agricultural Products Act. And we've got 52(2), which talks about your rental pools, timeshare rental pools, owners of sectional title interests, and so on. And the issues there is that the pool, with the agreement of all the members who are then forming this pool, the pool can be separately registered and is regarded as a vendor in its own right and is treated as a principal, not as an agent of the underlying vendors. It's a separate vendor. But now they've identified that there's other things that should be considered as well. And this is what's coming into 52(3). And then the fourth area that they're bringing into the main part of the Act talks about documentary evidence for repossession. So a finance house that is repossessing goods, and especially considering what happens with the documentary requirements when they repossess goods from somebody who's not a vendor. Now, okay, if you've got a vendor who's repossessing goods from another vendor, clearly you've got to supply from one vendor to another, and you would then have your input tax that is claimed. You've got the finance house basically would be looking at claiming the input tax when they recover those goods. But if they recover the goods from a non-vendor, it's kind of akin to a second-hand goods transaction where they're looking at claiming a notional input tax. And then what about the documentation? It's not always easy for them to get all the documentation that they might need from this client who's now somewhat disgruntled about the fact that these goods have been repossessed. So they have a special rule that comes into play around documentary evidence in those circumstances. So I'll look at those 4 amendments, and then we'll see that there's 2 other standalone amendments. The one amends section 913, which links to 18D. That was an amendment that came through last year. And the other is an amendment to 23(1)A, which is the registration requirement for non-resident providers of electronic services. Okay, so there's basically 6 of these amendments we need to just run through quite quickly. So with foreign entities, in section 23(2)A, this is a new provision that has been inserted, and it's supposed to make things easier where you've got foreign entities if they're part of the same group of companies as a South African entity. You see, currently, when you look at the definition of enterprise in section 1, together with the requirements for registration in section 23, anyone conducting an enterprise in the Republic, if their taxable supplies exceed that R1 million threshold, they have to register as a vendor. But this non-resident might not have a physical presence in South Africa. In that situation, they would have to appoint a representative vendor, and they have to open a South African bank account. And that has been identified as posing administrative challenges and possibly disincentivizing foreign investment. And so the amendment here is really allowing a resident vendor to register a single branch in respect of all non-resident companies that are part of the same group of companies. It can be all or any. It doesn't necessarily have to be all of them. You'll see that there is the option to opt out of this. But if they want to, any non-resident companies can then fall under the umbrella of the South African resident vendor, and they'd fall under the branch of that resident vendor, and that would hopefully alleviate some of the challenges for the VAT registration for these foreign entities. But bear in mind, they have to be part of the same group of companies. So you see here the section 23(2)A, it says a person who's not a resident who becomes liable to register may be registered as a branch of a registered vendor upon written application. And then there's a whole lot of provisos, but I've given you the gist of this provision that basically they would fall under the umbrella of that South African vendor. Notice that if they decide to go along with this registration as a branch of the South African vendor, the main registered vendor and each person who's a non-resident are still jointly and severally liable for any tax due by that branch. And then notice that the non-resident can opt out of this. They can elect and apply to register as a vendor if they want to. They don't have to fall into this branch registration. So any company that's part of the same group as defined in section 1, which can include non-resident companies, they can fall under the umbrella of the South African vendor. But any of those companies, if they want to register themselves separately, they can opt out of this provision, and then this provision will not apply. They will then do their own registration. So this comes into effect from the 1st of January 23. You'll see all of these amendments dealing with Section 72 decisions all have the same effective date. Then we look at our flash title sales, all right? So the South African resident vendor sells goods to QP1, qualifying purchaser 1, who immediately on-sells to another qualifying purchaser. These people are non-residents. And the question is that QP1, do they have to register? So this particular paragraph is basically going to say that they don't have to. And they do that by saying that when goods are supplied by QP1 to QP2 under a flash title sale, then in essence, the activity of QP1 is deemed not to be the carrying on of an enterprise, and therefore they would not have to register as a vendor. All right. They do, however, make the point here that you can again opt out of this. So if QP1 does want to register as a vendor, they can opt out of this, and they would have to apply in writing, and they would then direct that this doesn't apply, and they would then register as a vendor according to the other registration provisions. And then as far as pooling is concerned, so I mentioned that we're going to be adding in this extra subparagraph 3. And the motivation here was explained as coming specifically from the medical profession, where they specifically referred to incorporated medical practices, which would have a pooling arrangement. And they obviously had a ruling that said that they could treat that pool of practitioners as a separate vendor. And now they're bringing that into the act. So they're saying any pool, this is now subsection 3, right? Any pool managed by any person for the benefit of the members, not a pool contemplated in 1 and 2, that's your agricultural and your rental pools. So some other pool may, on written application, be deemed to be an enterprise carried on separately from the members. And then they say, provided that the pooling arrangement is established as a manner of compliance with the provisions of the laws of the Republic or regulations or rules promulgated by a professional body. So they don't specifically mention the medical profession, although they say that is what prompted this amendment, but it can be any pool under the rules of the laws of the Republic or promulgated by a professional body. Such pool must elect in writing, and each person must elect in writing that they're going to have this pool treated as a separate enterprise, separate from the individual members of that pool. And notwithstanding the provisions of section 54, that pool is then treated as a principal and not an agent. Section 54 is the agency provisions, but in this case, the pool is not an agent, it's a standalone vendor, it's a principal in its own right. In terms of subsection B of that section, they do make the point that there's still going to be joint and several liability for the pool and all the underlying members if there's any outstanding VAT. And again, that comes into effect from the 1st of January. And then the record keeping requirements was the other one I spoke about with repossessed goods, a new provision. So we've got section 28, which talks about the record keeping requirements when you've got goods repossessed from a vendor. But in this particular case, where a supplier makes a deemed supplier, so you've got the goods that are being effectively supplied from the debtor back to the creditor, okay, but it's not a taxable supply. So debtor is not a registered vendor, but the creditor is a registered vendor. So you've got a deemed supply under section 810 to a recipient being a registered vendor. The recipient has to maintain sufficient records to enable the following particulars to be ascertained. And there they go into the detail of all the documentary requirements. So it does to some extent link back to the existing section 28, but it then has some additional requirements that apply. Okay, then let's get on to this one, the amendment to section 913, which links to section 18D. Now, section 18D was an amendment that came through in 2021 Taxation Laws Amendment Act, although it was effective from the 1st of April 2022. And it speaks specifically to property developers who are developing residential property. Now, ultimately, they're going to sell that residential property as a taxable supply. And so along the way, they are claiming all of their input tax credits, right? Because ultimately, they're going to make a taxable supply. But section 18D considers a situation where somewhere along the line, you haven't yet sold that property, but then you rent it out. So they talk about it being temporarily applied in accordance with section 12C. And section 12C of the VAT Act talks about an agreement for the letting or hiring of a dwelling. In other words, it's a lease agreement for residential property. Okay, so you thought you were going to sell this property as a taxable supply, but then you start renting it out temporarily because perhaps you can't sell it or you've got a cash flow issue and you need to get some rental income. Now, the thing is, if you think about section 12, that is one of our exemptions, all right? It's an exempt supply. And we know this, the letting of residential property is an exempt supply. So we have a change of use. Initially, you thought you were going to sell this property as a taxable supply, but now you are renting it out, but it's being temporarily applied in accordance with section 12C. So you still ultimately think you're going to sell this property, but in the meantime, you are renting it out. Okay, so the point of the matter was that Section 18D then created this deemed supply situation. The property is deemed to have been supplied in that circumstance as a taxable supply. That's to effectively reverse our previous input tax that we've been claiming. And 18D clarified that the consideration is what we call the adjusted cost, which is the cost on which VAT was charged. So that basically is saying that we are going to reverse our previous input tax, then becomes output tax at the time of the supply. And this is where we get into Section 913. Section 913 tells us that the time of supply, and this is what it says currently, it says the tax period in which the agreement for letting and hiring comes into effect. But now they've realized that that wording is less than perfect. You see, if you're just looking at the time of supply when the agreement comes into effect, it must be pretty easy to delay the time of supply by just not having the agreement come into effect yet. So they've now clarified that, and they said, no, what we actually want to say is this. We want to say that the time of supply is deemed to be the date, the specific date within the tax period in which the agreement for letting and hiring comes into effect, or in which the dwelling is occupied, whichever happens first. So a bit of a kind of an anti-avoidance provision there. So it could be triggered by occupation through this temporary supply, or you've got this agreement for the letting and hiring that actually comes into effect. So whichever happens first, that will trigger this deemed supply in that tax period. On that date, within that tax period, you've now got to reverse your input tax. And this effective date of the amendments to Section 913 is backdated to when the previous amendment came in, and that was the 1st of April 2022. Okay. Right, and then the last one, the last VAT amendment, is this one dealing with non-resident suppliers of electronic services. Of course, non-resident suppliers of electronic services are required, if they're supplying those services to a resident, there's a specific requirement for them to register as a vendor if their suppliers go above R1 million. They then have to raise VAT, charge VAT to your resident user, issue tax invoices, etc., operate as a vendor. Now, the issue is that we talk about their suppliers exceeding R1 million and with no exception, but the general rule for registration, if you think about everybody else, Section 23(1), it says that if a person is making taxable supplies that exceed R1 million in a 12-month period, other than where you go over R1 million just because of a once-off situation or an abnormal circumstance. But they don't say that for electronics service providers. And so they want to also bring that in, and that's why they're making this amendment to Section 23(1). So what that will say, it talks about your supplier of electronic services to a resident who would have to register as a vendor if their taxable supplies exceed R1 million, except that they will not be liable to register if they go above R1 million solely as a consequence of abnormal circumstances of a temporary nature. Okay, so just bringing in the same wording there that we see with everybody else. And this comes into effect from the date of promulgation of the Tax Administration Laws Amendment Act of 2022. All right, that brings us on to some of the other amendments in the Tax Administration Act. There's three specific ones that I'm going to talk about. Bringing the employment tax incentive within the scope of the understatement penalty, the issue around URBA being an approved RCB, and then tax compliance status. Now, if we look at the understatement penalty, now the understatement penalty is the Chapter 16 penalty, which is levied where there is an understatement that has caused prejudice to SARS. And an understatement is defined in Section 221 as being, as I say, where there has been prejudice to SARS that is caused by failure to submit a return, an omission from a return, an incorrect statement, etc., or an impermissible avoidance arrangement. And linked to that, all right, so that would trigger the penalty, but the penalty is actually levied on the shortfall in tax, the tax shortfall that arises from the understatement. So if you have claimed a deduction that you're not entitled to, or you have omitted certain income, etc., you've ended up with an understatement. What is the tax shortfall? What should the tax have been? And what is the tax that you've reported as a result of overclaiming your deduction? So that tax shortfall multiplied by your penalty percentage is the actual penalty. But of course, it hinges around this issue around a tax shortfall, which ties back to this concept of tax. All right, to talk about a shortfall in tax. Now, the argument has been that if you have an employer that overclaims an employment tax incentive, it's an incentive, it's not a tax per se. And so the argument was that the understatement penalty could not apply then, because that doesn't come in within the scope of the understatement penalty in Chapter 16. And so they've said in view of the abuse that they're seeing with ETIs and people overclaiming ETIs, they want to be able to levy the understatement penalty on ETIs, and so they need to amend the wording. Remember that the Tax Administration Act is very rules-based, so you might intuitively think that surely you must be able to charge an understatement penalty on overclaiming an ETI. But if the provision does not specifically allow for it, then you would not be able to apply that understatement penalty. And obviously there has been a dispute between SARS and one or more taxpayers around this issue around the understatement penalty on an ETI. And so they want to make 100% sure that they can bring the overclaim of an ETI within the realm of the understatement penalty provision. So they're doing this by classifying that there's two sides of this amendment. The one is to the ETI Act in Section 10. Everywhere where it talks about a reimbursement, they're now deleting that and referring to it as a refund, all right, a refund of tax under the Tax Administration Act. And then in Section 221, where we talk about the understatement penalty and we talk about the definition of tax. So at the moment, tax is defined in Section 221 as meaning a tax as defined in Section 1, excluding a penalty or interest, and they're just extending that to specifically also include the employment tax incentive. And so that will ensure that if an employer overclaims an employment tax incentive, you would then say, what is the result of the tax shortfall? And that overclaim effectively there is your tax shortfall. You would then apply the relevant penalty percentage to arrive at your understatement penalty. Now, notice here that this amendment is already in effect. It came into operation on the 1st of September 2022. And it applies to any employee's tax return submitted on or after 1 September 2022. Okay, so that's already in place. Although it does then leave the question, any ETI overclaimed for periods prior to this, would you be able to levy the understatement penalty? SARS may still argue that they can, but this just makes 100% sure that they certainly can for returns submitted on or after 1 September 2022. Right, and then we get on to Section 240A of the Tax Administration Act, and that deals with recognized controlling bodies. Now, any registered tax practitioner, any person who's required to be registered as a tax practitioner, has to be registered with SARS and also with a recognized controlling body. And in Section 240A, it says that the commissioner must recognize as a recognized controlling body, and then subsection A, the RBA, subsection B, the Legal Practices Council, and then D, because they deleted C, D, any statutory body that the commissioner is satisfied is similar to these statutory bodies and the details of which are published in the Gazette. And then, of course, it goes on to say the criteria for the commissioner to recognize a controlling body as an RCB. The issue is that the RBA is identified there front and center in paragraph A, and they've now asked to be deregistered or derecognized or taken out of the Tax Administration Act. And they're saying that's because any member of the RBA by definition would have to be a member of SICA, and SICA is already identified as a listed RCB, and so the person would be a tax practitioner registered with SICA, and so there's no need to have the RBA so registered. And so for that reason, they're saying that they don't want to be listed there, and so they've said, right, they're going to take them out. You'll no longer see them referred to in Section 240A. It does mean that anybody who may be a SICA member, but perhaps they had nominated the RBA as their RCB. If the RBA is no longer listed as an RCB, and this will be from the date of promulgation of the this Amendment Act, which will probably be in January next year, then that person would have to now move across to SAICA. Now, you might already be a member of SAICA, but you're not listed, you haven't nominated SAICA as your RCB. And so you'd have to then move across from the RBA to SAICA as your RCB. And that's going to have certain complications attached to it. It's not as simple as simply saying, well, I'm just going to move across, because SAICA now has to go through the process of basically appointing you or recognizing you as a registered tax practitioner. All right, but that is the implication there. But just take note that if you have nominated the RBA as your RCB, you will have to now change that and nominate SAICA as your RCB, and you have to then work with SAICA to actually register with them as a tax practitioner. Right, and then section 256, which deals with the tax compliance status. Now, for a person to be recognized as tax compliant, they have to, of course, not have any outstanding tax returns. They have to be registered for everything that they need, that legally obliged to be registered for, and there must be no outstanding tax debt. Oh, let me just see, I have a question here. Yeah, the assessed loss limitation. Yeah, closed corporation is a company as defined. So that would include closed corporations, yes. Okay, all right. So to be tax compliant, as I said, deals with registrations, returns, and tax debt. Now, of course, tax compliance status is important for taxpayers. I mean, even to be a registered tax practitioner, you've got to have tax compliance status, right? It also applies to people who want to apply for government tenders. It also applies to people who want to get money out of pension funds, etc., etc. Section 256 is being amended in two respects. The one is that SARS wants to indicate when a person is a newly registered taxpayer, because they say that people must be cautious. If the person's newly registered, they've never been put to the test. They haven't yet got to the point where they had to submit a return or make a payment. And so SARS wants to identify them as a newly registered taxpayer. They say so that users can be aware and exercise additional due diligence. So that's the one aspect. And then the other amendment deals with SARS' right to revoke third-party access to a person's tax compliance status. So in other words, you know, they would give the PIN, but then they switch off access. So nobody can access your tax compliance. So there's no way of telling whether you're tax compliant or not. Now, that does already exist, but they are expanding the circumstances in which they can revoke that third-party access. So if we look at the amendments, section 256.4 talks about the indication of tax compliance. Currently, it says this, and it talks about A, B, and C. So that you'd have to, on SARS tax compliance system, it would indicate the taxpayer's name and reference number, the date of the compliance status, and what that status is. And now they're adding in paragraph D, which would also indicate if the person is a newly registered taxpayer. So up until the first date of a return or a payment, or 1 year, whichever happens first. Okay, then the person would be flagged as newly registered, high risk, in other words. Then the issue around revoking third-party access. So here, this is an amendment to 256.6. Again, it's not a brand new provision. We already have this provision that says a senior SARS official may revoke access if it was provided in error or on the basis of fraud, misrepresentation, or non-disclosure of material facts, if proved, in other words. But now they're amending that, first of all, to say a senior SARS official may revoke access, and then also those circumstances, or if the correctness is questioned due to fraud, misrepresentation. So there's a suspicion of fraud, misrepresentation, or non-disclosure. And in those circumstances, SARS can revoke. But in either circumstance, A or B, they have to first give 10 business days warning to the taxpayer and give the taxpayer the opportunity to reply and rectify if necessary, or to persuade SARS that there is in fact no fraud. They might have suspected, but there is in fact no fraud. In other words, if the taxpayer suddenly submits a whole lot of nil returns to ensure that there's no outstanding returns, SARS might suspect that there could be fraud because is it correct that there should be nil returns, or is this company in fact still trading? And so they might then raise the query. And obviously, you shouldn't be submitting nil returns if the company is still trading. That would be fraudulent. But if the company in the meantime has ceased trading, then a nil return might be appropriate, in which case you would respond to SARS and indicate that and give proof, all right, that the nil return is valid. And then they shouldn't revoke third-party access. Okay, so that's basically how that amendment is coming in. Right, so that brings us to the end of the legislative amendments, and we're running out of time. We really just have another 10 or 15 minutes to go. But we have got some recent SCA judgments. These are the ones that I haven't spoken about previously. In our mid-year update, we dealt with some of the judgments, and these have come about since that mid-year update. Now, I'm going to jump through most of them very quickly, but just to make you aware of the key issues in these judgments. You'll see I have got a little bit of information on the slides, and I'm just going to really go through this at a high speed. Okay, so with Rennie's Travel, this was a case that dealt with a VAT issue. Rennie's Travel being a travel agent, they arranged air travel for clients, and the question was whether whether certain of their suppliers should be zero rated or standard rated. And it spoke specifically to supplementary commission. And whether that should be zero rated. But then there was another issue dealing with a tax administration issue, and that was the question around the time for lodgement of a notice of appeal. There's a deadline by which the taxpayer here had to lodge their notice of appeal when they took this matter on appeal. And when you look at the rules of the SCA and the rules under the Tax Administration Act, there's a conflict between those provisions. And depending on which provision takes precedence, the taxpayer may or may not have met the deadline for lodging their appeal. Okay, so if we look at the background, I've said there that they arranged flights for clients, airline tickets on international flights. Now, the arranging of international travel would be a zero-rated supply. But they also charge service fees to the client. That would be a standard rated supply. But what was in question was this third aspect of supplementary commission. And that was paid when they sold more than a certain number of tickets. The taxpayer argued that that should also be zero rated, like their standard commission. But SARS argued that the supplementary commission was earned by marketing and advertising work done by the airlines in South Africa, which would then be a standard rated supply. So the question was, of course, which rate applied. Now, first of all, just looking at this question around the lodgement of appeal. So we've said that the SCA rules and the Tax Administration Act differ. Which one takes precedence? And the ruling of the SCA was basically that the TAA, being national legislation, took precedence over the SCA, which was more of an internal rule. And so if we looked at the rule under the TAA, which then was the one that took precedence, that meant that the taxpayer was within time, and so therefore the appeal could be considered. So looking at the question of zero rated versus standard rated, as I say, the normal sale of airline tickets, the standard commission, it was accepted, that was zero rated under Section 11.2. But the supplementary commission, what about that? Well, the SCA held that that was part and parcel of the same sale, and therefore it should also be zero rated. Okay, so the appeal of the taxpayer succeeded, and SARS was required to set aside the additional assessments, and that those suppliers were zero rated. When we look at Capitec's case, also dealing with a VAT issue, and this particular one, Capitec, of course, being a bank, financial services, and normally, of course, suppliers made by a bank in terms of interest and so on, those are suppliers of financial services. Exempt supply would not carry VAT. Now, in this particular case, Capitec was actually looking at a notional input tax credit that they were claiming. And it linked almost to an insurance aspect. It looks at Section 16.3C of the VAT Act, which is a notional input tax deduction that you would normally have claimed by insurance companies when they are paying out an insurance claim. Of course, that's a deemed supplier for the person receiving that payout. For the company paying the amount, they would get this notional input tax credit. Now, Capitec was providing insurance to their clients so that they were covered. Remember that they were in unsecured lending, right? That was their business, unsecured lending. And so they were providing insurance to their clients who would then be able to have their debt insured if the client was retrenched or died and they were not able to repay the debt. Then the insurance would pay out and that money would then be used to settle the debt owing to Capitec. And it's that payout from Capitec to the clients on which they were claiming this notional input tax deduction. And that was an amount of 71 million rand. Now, they claimed this as a deduction. SARS felt that they were not entitled to the deduction. So as far as SARS was concerned, and this was for a particular period, right? SARS felt that they were not entitled to it, so they had underpaid their VAT, so they levied a 10% late payment penalty. So the question was, were they entitled to the input tax deduction, yes or no? If yes, then great, of course the penalty would fall away, but if not, then the amount of tax was due, but then what about the penalty? Should that be remitted? Okay, so the background along the lines of what I've said, unsecured lending, that Capitec had taken out the insurance underwritten by a guard risk. They then paid out these amounts of 582 million to their clients, applying the tax fraction, that was the notional input tax credit that they were claiming. And they had an opinion that indicated that they should be eligible for that input tax credit. But SARS argued that those payments didn't qualify for the notional input tax deduction because the supply of the loan cover did not constitute a taxable supply, as Capitec didn't charge any consideration for that insurance cover, the loan cover. And because the loan cover was supplied in the course of a business of providing credit, that financial services business, which is an exempt supply. Okay, so at this stage, Capitec was not charging. That was the key thing. And so they were saying there is no taxable supply. And if you look at section 16.3, the notional input tax credit that they are looking at claiming, it talks about where you're making payments in the course of making taxable supplies. All right, so at the end of the day, the conclusion of the SCA was, in fact, that SARS was correct and that the notional input tax credit was not available to Capitec. But then, of course, the question was whether the late payment penalty should be remitted, and it was held that it should be remitted. Now, in terms of the remission rules for late payment penalties, you've got those three requirements that come through in section 217, right? The first one says that basically, is it a first incidence of non-compliance or less than 2,000 Rand? Oh, clearly this is more than 2,000 Rand, but was it a first incidence? And in this case, it was. Capitec had no penalties in the last 36 months. The other one was, has the non-compliance been remedied? And in this case, it had been remedied because they had actually paid the VAT that was owing. So then the other question was, were there reasonable grounds for the non-compliance? And that's really the key thing here. And the court held that because Capitec had taken advice that they were eligible for this input tax deduction, and they had to test that by actually claiming the deduction. And so they were unsuccessful, but there was no mala fide as far as their claiming was concerned. They were acting according to their directive. And so the court held that there were reasonable grounds, and that's an interesting one, reasonable grounds for the non-compliance. So they said the penalty should be waived. Okay, moving on to the airports company here, they were looking for a declaratory order, and this was looking at basically an amendment around, sorry, I'm thinking about another case. Sorry. Airports company was looking at whether it was permissible to amend the grounds of objection, and they basically said that you cannot amend your grounds of objection, and I'm not going to go into all the detail there. Similar outcome for Nessun Goswe, also looking at basically amending the grounds of objection. And they said that he couldn't go and change that. So that was the outcome there. Now, I'm getting on to what I think a lot of people are mostly interested in, and that is the Thistle Trust. Now, the Thistle Trust case looks at this whole question about Section 25B and paragraph 80 of the 8th schedule. And in this case, the Thistle Trust was a trust under some umbrella trusts. So there were what they called the tier 1 trusts. So there were a number of tier 1 trusts. They made distributions, or they vested amounts into the Thistle Trust. And this was specifically concerned with capital gains, which had arisen from the tier 1 trusts' disposal of assets. So the tier 1 trusts disposed of assets, and they distributed those capital gains to the Thistle Trust. Okay, so that part is fine. In terms of paragraph 80, subparagraph 2, we would disregard the capital gain in the tier 1 trust, and the capital gain would have to be dealt with in the Thistle Trust. But the Thistle Trust, in the same year of assessment, then distributed the capital gain to its beneficiaries in the same year of assessment. And the Thistle Trust argued that that kind of pour through, that distribution of the capital gain onto its beneficiaries, meant that the capital gain was not taxed in the Thistle Trust, but should be taxed in the hands of the beneficiaries. Now, the tax court had agreed with the Thistle Trust and said, indeed, the conduit principle applies to the capital gain, and it could flow through to the beneficiaries and be taxed in the beneficiaries' hands. But SARS, as you can see here, the commissioner took this on appeal. And so the question was the capital gain actually taxed in the hands of the Thistle Trust or in the hands of the beneficiaries? Okay, so coming from the tier 1 trust into the Thistle Trust and then through to the hands of the beneficiaries, could we flow that capital gain all the way through to the beneficiaries, or did it get stopped at the Thistle Trust and it had to be taxed in the Thistle Trust? Now, the taxpayer here, the Thistle Trust, was arguing that the conduit principle applies in terms of section 25B, and that applies across the board also to capital gains, and therefore that should flow through to the beneficiaries. Now, the years of assessment are important here. This happened in the 2014, 15, and 16 years of assessment. At that stage, when you looked at section 25B, it actually spoke about any amount, and it didn't specifically, what we see now in section 25B, when you look at the wording, it talks about, it's been amended, it was amended in 2021, and it says specifically any amount other than an amount of a capital nature, etc. Okay, so it's very clear now that 25B applies to income and not capital, because capital amounts are dealt with in terms of paragraph 82. And paragraph 82, when it talks about a capital gain, it talks about a capital gain determined, any capital gain that is determined by a trust, and that requires that it must be the trust that actually disposed of the asset. So that would be the tier 1 trust disposed of the asset. That capital gain could be distributed to the beneficiary, which was the Thistle Trust. But then the Thistle Trust was not determining a capital gain in terms of paragraph 80. It was simply on distributing that capital gain. And paragraph 82 didn't contemplate that would then enable the capital gain to be taxed in the beneficiary. So the question is whether section 25B applied to that capital gain, or was it only paragraph 82 that applied to that capital gain? And the court came to the conclusion that 25B does not apply, that paragraph 82 applies, and therefore the capital gain should be taxed in the hands of the Thistle Trust. Then there was the question around an understatement penalty. So SARS levied an understatement penalty of 50% and also section 89 quat interest. And the question was whether that understatement penalty should be remitted. All right, so the SCA held here that when the provisions are read as a whole, it's apparent that the legislature intended that 25B only applied to income and not to capital gains. Capital gains are dealt with in the 8th schedule, and therefore paragraph 82 must apply. And that requires that the capital gains are taxed in the Thistle Trust. And they said the tax court was wrong, and therefore they basically reversed the decision of the tax court. So they said that the SARS additional assessments must stand. And that, of course, then brings us on to the question of the understatement penalty, because SARS had levied a 50% understatement penalty on that additional assessment for the trust. Now, very interestingly, I think, although a lot of people don't seem to focus on this aspect of the judgment, but I think this is quite interesting, is that they actually came to the conclusion in the judgment that SARS had conceded correctly that the understatement on the Thistle Trust tax return was a bona fide inadvertent error, as it had believed that Section 25B was applicable to the case. And they applied SARS had originally applied the 50% penalty. 50% applies to no reasonable grounds for a tax position. But then SARS conceded that actually it was a bona fide inadvertent error, so there would be no understatement penalty, which is really interesting because up until now, SARS has had an extremely narrow interpretation of what is meant by a bona fide inadvertent error. So there they actually conceded that there was a bona fide inadvertent error, and therefore there would be no understatement penalty. However, the Section 89 quat interest would stand, and the trust conceded to that. Yeah, so an interesting one, although there's apparently an indication that this case is going to go on appeal to the Constitutional Court. Well, that remains to be seen. SAICA, in the meantime, issued, I saw today, a tax alert where they indicate that they agree with the outcome of this case. Some people are obviously not happy with the outcome of the case, and that's why there are grounds, they feel, for taking this on appeal to the Constitutional Court. Of course, this has always been SARS' view that you can't pour over a capital gain from one trust to another trust. And this is confirming the view of SARS that they have in their comprehensive guide to capital gains tax. But it's going to be interesting to see what happens with this judgment going forward. Then just finally, our SARS documents, and I think I'm just going to have to basically give you all these slides and just leave it at that. But I've got a list of all the new interpretation notes that have been issued during the year, the updated interpretation notes. Pay special attention to the interpretation note on Home Office expenses. Then also the binding general rulings. There have only been 2 that have been issued, and they have fairly specific application. Binding class rulings, there's quite a number that have been issued. Pay special attention to BCR 080, dealing with a foreign pension trust and the tax implications. The rest have very specific application. And then your public notices, of course, if any of you are dealing with disputes around the non-compliance penalties for failure to submit income tax returns, you would want to pay close attention to what the notice actually called for, who had to submit tax returns and when. So you might want to pick up that notice on the SARS website. And then the other notice dealt with VAT, the domestic reverse charge relating to valuable metals, very specific application. SARS interest rates, remember that the official rate of interest kicks up every time the Reserve Bank raises their repo rate. And I see that this afternoon we've had another 75 basis points increase. So that means our official rate of interest on the 1st of December will go up to 8%. So be very careful, because that means that that has a direct impact on tax liabilities that arise as a result of Section 7C, Section 64E for the deemed dividends, and also your fringe benefits on low interest loans. So yeah, just keep a note of that. And remember that you have to be using this official rate of interest in calculating the interest benefits on those effective loans. Right, so that brings me skidding into just before 5 o'clock, and brings me to the end. I don't see any other questions that have been noted. Everyone's suddenly gone very quiet. But if you do have any last minute questions, you are welcome to just log them. Otherwise, I will hand back to Stan and just say thank you very much, everyone, for joining us this afternoon. I hope it has been a really useful session for you, and I wish you well for the rest of the year. Thanks then. Goodbye, everyone.
Cheers. Thank you, Jackie.
Thank you, Jackie. And thank you, everybody, for joining us. It's the last session for the year. And just a couple of points. If you have certificates missing or you need anything, please let me know, and we'll provide them. To those that are going away, taking a break, or traveling here or overseas, locally or overseas, we wish you a pleasant journey and a safe return. And we are planning the seminars, the webinars for 2023, which we'll let you have early in the new year, as soon as they're available. And once again, Prof, thank you for joining us, a very thorough explanation of the situation regarding SARS, which is always a minefield. And as I say, good night and pleasant end of the year. Good night.
Right.
We
I think everyone's logging off to go. So all the best,
Cheers.
everyone. Have a